Hey, Jamie here, and welcome to part 2 of our final module, Module 12, where we're breaking down financial freedom. Now, in part 1, we covered a lot of the philosophy and the underlying thoughts around how to think about financial independence, financial freedom, risk management, and then how to focus on always putting investing before spending. Invest before spend, invest before spend. And so we talked about at the very end the Waterfall financial management system and how you can apply that in order to think through your personal finances and managing your money and setting yourself up for financial freedom. So this part 2 is covering the core strategies behind how can we actually step by step implement this type of a framework, this philosophy into our lives. So in this part 2, we're going to understand the differences between checking accounts, saving accounts, and investment accounts. We're going to understand the differences between tax-advantaged and non-tax-advantaged accounts. We're going to understand the differences between traditional and Roth retirement accounts, understand the differences between public and private investments, understand the importance of and how to actually think about diversifying risk in your security bucket. We're going to understand the crucial differences between mutual funds and index funds, and that point alone, when we talk about the mutual funds versus index funds, that alone will save you over $100,000 in your life. So it's super important. And then understand different tools, resources, and recommended reading for financial freedom. And then we'll go through how to set up your Waterfall financial management system so that there's going to be a step-by-step sheet. So in an Excel or a Google Doc spreadsheet that I'll be walking you through so that you can be putting in your numbers and thinking through how do I want to structure my waterfall. And then finally is understand how to go about setting your cost of living target to accelerate your financial freedom. Awesome. So another disclaimer, and I will continue to always include this because it is very important to know I am a coach. I provide information and training. I'm not a doctor, a nutritionist, a fitness instructor, a therapist, a psychologist, a wealth manager, a wealth advisor, or a licensed practitioner. Again, I am a coach. I provide you with information and training. It's your responsibility to determine what is relevant and helpful and worthwhile for your life and career. All decisions and actions are solely your own responsibility. Awesome. Okay, so diving in, there are different types of accounts that you must understand for managing your money. And there's a reason that there are different types of accounts. All of them have different purposes. So the first one that I'm sure you're very aware of is a checking account. Now, a lot of people keep a lot of money in their checking account. Well, and oftentimes they're actually losing a lot of money, what they don't know. So think of a checking account as it's an account, usually with a commercial bank, where you can deposit and withdraw money as frequently as you desire. Now, there may be limits like 250 transactions a month or 500 transactions a month, something like that. And very, very few people ever hit those limits. But the idea is you can think of a checking account as an operating account. It's kind of like all of your money goes into it, and then from there, you decide what to do with your money. So it's more of an operations account instead of a saving or investment account. So in your checking account, it's really important to know you are earning little to no interest on your money. And it's so small, it's literally, there's no interest on your money. So over the long term, because you're not earning any interest on that money, over the long term, inflation begins to eat away at the money that you're holding in the checking account, which is why you don't want to hold large amounts of money in there. You only want to hold enough in there to maybe cover 2 months worth of cost of living at most. Anything over and above that, well, you're losing buying power. So in order to show what this looks like is, let's say that in your checking account, and if you're with one of the major commercial banks, so whether that's JP Morgan, Wells Fargo, Citi, etc., a lot of those, most commercial banks for their checking accounts are paying literally like 0.01% interest, like almost nothing. But inflation is usually going to be between, probably call it 1% to 3%. Now, are there going to be periods of higher inflation? Yes. Are there going to be periods of lower inflation or even possibly deflation? Yes. But for the most part, the Fed mandate is to shoot for 2%. So we can reasonably expect that over the long term, inflation will be somewhere between 1% to 3%. So what that means is if we're not earning any interest on this money and inflation is going to roughly be between 1% to 3% most of the time, well, it means that we're actually losing money. Now, I want to take a quick second to describe what inflation is, just in case that you don't know. I'm going to assume you probably are familiar with it, but just in case you don't. So inflation is over time, more currency will need to be put into the economy. So the government will print more money and create more money. Well, the more money that's created, the lower the value of the currency in circulation. The buying power will reduce. So, as an example, let's assume that you walk into a grocery store and there's only one apple. Well, if everybody in the grocery store wants an apple, well, people are, supply demand, that apple is going to be pretty expensive. But let's say you go into the store and there are 500 apples and there's more apples than anyone could possibly want to buy within the store. Well, the value of the apples is going to fall. I mean, it's just simple supply and demand. And so inflation really is primarily driven by supply and demand. The more currency that's printed and put into the economy, the buying power will fall. Or the buying power, the value of the currency will go down. And that's pretty much what inflation is. Okay, so with inflation, and because we're not earning money on that, on the money, or we're not earning interest on the money that we have in the checking account, over time, our buying power will fall by X%. So you can see here, this is assuming 1.5% inflation over 30 years. Well, if you were to just put $10,000 into a checking account and let it sit there, at the end of year 30, it would only actually have a buying power of about $6,374. So that's why we don't want to keep large amounts of money in the checking account. It's an operating account, money goes in, and then you want to do things with it. You want to move it. So, checking account, some important things to think through are, one, how much are you paying in total fees? So some banks will have really bad overdraft fees, or maybe they have a minimum balance fee. So you can see here is the second point. So a minimum balance fee is where a bank might say you need to always have a balance of $1,500 or more. And if you don't, then we're going to charge you $12 a month or $15 a month. Well, $15 on $1,500. So if the minimum balance is $1,500, and you're paying $15 a month, that's 1% a month. So that means you're really paying 12% just to have a bank account. That's craziness. So, and think of what you're doing. You're giving them your money. They're charging you to give them your money. It's craziness. And then they're taking your money and making loans with it and making money off of your money while at the same time charging you money. So if you're paying a minimum balance fee, you need to get rid of that. Either move banks, or what you can do is negotiate. You call up the bank and say, hey, I noticed that temporarily my account balance dipped below $1,500 or $1,200, whatever it is, and I noticed that I was charged a fee of $15 or $20. I'd like to ask to have that please removed. And now if they say, I'm sorry, we can't do that, you could say, okay, well, I've been a loyal customer here for X period of time. I'd really like to stay with this bank, but if every time I accidentally move across that one line and you're going to charge me $20, I'm going to have to move banks. Well, all of a sudden, you've made it clear that they have something to lose. Not only have you been a loyal customer and you've kept their money with them and you've built loyalty with them, but now they might potentially lose you as a customer over $20. The cost of acquiring a customer for a bank is thousands of dollars. It is extremely expensive to get you as a client. And they also know that customers of banks are sticky. And what I mean by sticky is people hate having to move their money. It's a huge hassle. At least they think it is. It's actually not. I've moved banks multiple times. It's very easy to actually move your money. You open up an account at the other bank, you transfer it to that bank, and then you shut down the other account. It's super easy. But people think it's a hassle. And so because people think it's a hassle, what the banks know is, all right, if we pay X amount of dollars in advertising and marketing, we can get these people in as clients. And then once they're clients, they'll stick with us for decades. And most people do. Most people don't change banks. So the moment you put that on the negotiation table and say, hey, if you're not willing to work with me, I know other banks will. Well, all of a sudden, they don't want to lose you over $20 when they know how much it costs to actually acquire you as a customer. So super important there. Don't be afraid to negotiate with your bank. All right. So third point, are you primarily digital or do you consistently need to deposit checks or cash? Now, if everything that you do is digital, there are some banks that are primarily digital banks. So for example, I use Schwab. I love Schwab. I always have, always probably will, assuming that they continue what they're doing. But I really don't need to submit checks or physical cash. So Schwab doesn't have a really large branch network. So I don't need to go to ATMs to deposit money. But what Schwab does allow me to do is I can go to any ATM I want. And even if there's a 5% transaction fee or a 10%, withdrawal fee, Schwab will reimburse me for the fee. So I can use any ATM I want, and I can withdraw money from any ATM I want, and they'll reimburse me. So a lot of people think that the only banks that they can choose are the banks with the most amount of branches. That's not necessarily true. So you can choose different types of banks that have different options. So if you've always been with Chase, or you've always been with Wells Fargo, if you've always been with Citi, or you've always been with, call it whatever bank, question yourself, why am I at this bank? Is this the best bank for me? And then do some research. And you might find that maybe I do want to move my checking account to a different bank or my savings account to a different bank. Okay. And then finally, kind of another thing to think about is the quality of the consumer experience. It really is super, super helpful to be with a bank where you know the technology is good. Online banking or with your app or logging in online, it's super intuitive and easy and non-stressful. All right, so now let's talk about a savings account. And a savings account is also an account with usually a commercial bank, or it may also be with a credit union or something else, where you can deposit money, earn interest, and there's a federal limit. So this is a limit set by the government that you can only withdraw up to 6 times per month. So the reason for this is if you're moving money to a bank into a savings account, because they're limiting it to only 6 withdrawals per month, that money becomes more stable. And banks need stability in their funding in order to lend out money to businesses, to entrepreneurs, to local governments, etc. If there was no predictability and no stability in the deposits in the bank, that'd be a big problem. So they view savings accounts as more stable funding for banks. And because it's more stable and you're putting your money in there and you know that you can only withdraw 6 times, well, they're going to compensate you for that. So they're willing to pay you interest. So you earn minimal interest on this money. Now, over the long term, you match or slightly beat inflation because of this interest, which means that you're not going to lose buying power. So what this looks like is, let's say that your interest on your savings account is 2% annually or 1.5% annually. Well, in this example, I'm giving 2%. Now, let's say, again, inflation is 1.5%. Well, that means that your net interest is going to be half a percentage, or what's called 50 basis points. So if it's 0.5%, well then over 30 years, your $10,000 will grow to a buying power of 11,614. Is that substantial? No. And that's why it's a savings account, not an investment account, because the purpose of a savings account is not to grow your money substantially. It's to beat inflation. It's to not lose money to inflation. That's the biggest point of this. So think of this as it's highly liquid. And what I mean by liquid is you can access it instantly. You can access it very, very easily. So the reason people want to create like rainy day funds or as I advised in part 1, where you want to put 12 to 24 months of cost of living money aside in a savings account is by putting it in a savings account, it's not going to lose money to inflation. It's not going to lose buying power. That's point number 1. But then point number 2 is it's always accessible. It's very easily accessible. It's always liquid. All right, so that's a savings account. Now, as I just talked about, and we talked about in part 1, it's kind of you want to strategically build a safety cushion, and there's 2 main reasons for building the safety cushion. One is by having 12 to 24 months of money put aside in a savings account to cover your cost of living. One, you are hedging against market risk, economic risk. If you lose your job, if crazy things start happening in the economy, and all of a sudden you lose your source of income, your job, etc., you've taken care of that risk. You have money available. But then the second thing is because you have 12 to 24 months, you can actually make more strategic and higher risk decisions in your life. Maybe you decide that you want to start a business and you know that's going to take 6 to 12 months. Well, if you have 24 months of cost of living money set aside, well, you still have a full year of managing the risk for that. Or let's say you want to write a book and you know that's going to take time, and so you take time off. Or let's say that you want to transition your job to a different company. Well, if that's going to take a time and you're going to quit now and then take 6 months to do that, well, you have that covered. You've managed that risk. All right, so the other thing you want to do is find out whether or not you can auto deposit from your checking account into your savings account. Now, most savings accounts allow this, and most checking accounts allow it too. So what you can actually do is go into your savings account and create what's called an auto withdrawal. So it'll link to your checking account, and then you can set it to either biweekly or monthly and tell it specifically how much money to automatically pull from the checking account and deposit into your savings account every month. And I love, 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 love automatic deposits and automatic transfers and automatic pay, because the more that you automate, you'll stick to the system and you won't forget and you won't break your system. And in a financial machine that you're building, it becomes automatic. All right, then the next thing you want to do is figure out what interest rate are you receiving. So if you don't have a savings account, you can go to www.bankrate.com. And by no means am I affiliated with them, but it's kind of like what Bankrate does is they just provide all the different options and then tell you what all the different, it's a giant aggregation website telling you how much interest each bank is paying. And I include this at the end, but kind of, my 3 personal favorites in terms of savings accounts is I personally use Marcus by Goldman Sachs, but then I've also heard 2 other phenomenal savings institutions are Capital One as well as Ally Bank. So those are the 3 that I personally have done research on and know that they're good, and I personally use Marcus by Goldman Sachs. All right, so can you create sub-accounts within your savings account? And that's also why I like those 3. Is at Marcus by Goldman and Ally and Capital One. And again, I'm not affiliated with those in any way, shape, or form. But the reason I like them is 1, I know that they pay good interest rates most of the time. And then 2, I can create sub-accounts. And what a sub-account is I can move, let's say you move $1,000 from your checking account into your savings account. Well, what if in your savings account, you're putting that money there for multiple reasons? Maybe you're putting money into a savings account for a wedding, or for a future vacation, or for just your cost of living, and you're building up that safety cushion. Well, those are like 3 different reasons right there. And maybe you're even putting money aside into a savings account for Christmas shopping or holiday shopping at the end of the year. Well, you could have 4 or 5 different reasons why you're putting money aside. Well, with a sub account, you can create 5 different, savings accounts, if you will, within the same account. So it just makes it really easy to organize your money within one savings account. And then finally is, again, what is the quality of the consumer experience? Do they have good technology that makes it super easy to manage your money, both online banking as well as a mobile app? So that's checking and savings account. Now let's talk about health savings account. When it comes to the health and the medical side of finance and money, this is where a lot of people are like, I don't understand the medical industry at all. I don't know what's going on with healthcare. I don't know what's going on with my health savings accounts. Like, it's just this giant opaque craziness that people don't want to dive into. I promise you, it's not as complex as you'd think it would be, as other people make it to be. So a health savings account is it's a tax advantaged account. And it's either going to be with your HSA provider, a health savings account provider, or it's an account with your employer. So your employer sponsors it. And the sole purpose of having a health savings account is it's dedicated to putting money aside for future medical expenses. And it allows you to use pre-tax dollars. So it's money that you have not paid taxes on. And think about how much you're paying in taxes on your money. Well, oftentimes we're paying anywhere between 20 to 40%. So if you're paying 20 to 40% taxes on your money, then if you don't have to pay taxes on your money, and in this case for a health savings account, you're using pre-tax dollars, which means dollars that you have not paid taxes on, it's like getting 20 to 40% on automatically back on your money. So that's why it's super useful and powerful to be able to use pre-tax dollars for your medical expenses. And that's why the government created this, because it incentivizes you to put money aside, to save money, so that if something horrible happens to you or a family member, you have the money aside to pay for it. So in terms of health savings accounts, there are three primary options. So the first option is what is called a health savings account, HSA. The second option is a flexible spending account, or FSA. And then the third, and less frequent, is a health reimbursement arrangement, an HRA. All right, so now let's go through what these are. So an HSA is employee-owned health savings account. So you own this. And you may set this up through your company, but it's yours. So if you leave the company, you still carry forward this account because you actually own it. So it's employee owned, and it's used to pay for qualified medical expenses. Again, so this could be dentist, this could be if you break your leg, it could be hospital bills, it could be drugs, prescription drugs, it could be anything medical related. Contact lenses and glasses can also usually qualify for medical expenses. So you're putting pre-tax dollars aside for qualified medical expenses, and you're the one that owns the account. Now, for an FSA, it's an employer-owned health savings account. So your company owns the account, and the company sets it up for you. And again, you're putting money aside for qualified medical expenses. And then the HRA is, again, employer-owned. And what they do is they set aside money for you, the employee, and they pay for your medical bills. So maybe the company sets aside for all of their employees $3,000 of the company's money, and then you're able to use that money. So HRAs are great. It's literally like the company saying, hey, we're going to pay for your expenses. We're putting aside our own money to pay for your expenses. So you don't actually contribute to that account. It's all the company's money. And that's also why they're rare. Not a lot of companies set up HRAs. So if your company does offer an HRA, that's pretty awesome, because that means that the company's using their money and it's not you putting aside your own money. All right, so who contributes? For the HSA, it could be either you individually contributing, or oftentimes what a company will say is, if you put in $1,500, we'll match you $1,500. Or if you put in $2,000, we'll match you $2,000. So it's important to know, does my company match my HSA contributions? And even if they don't, you still want to put money into your HSA, because you're going to have dentist bills. If you have vision stuff, you're going to have vision bills, and nobody's going to be healthy forever. So you are going to have future medical bills. So you might as well start putting money aside into your health savings account, because you know that sometimes we don't know what's going to happen. And it's better to have access to pre-tax dollars than have to be surprised and then pay out of pocket with after-tax dollars and not get the 20 to 40% benefit that we could have had. So the FSA is employees and employers. So again, you are contributing money to it, as well as maybe your employer is matching you, or maybe they're not. But employees and employers are contributing to both the HSA and the FSA. But then for the HRA, it's only the company. It's not you at all. It's only the company's money contributing to the HRA account. So the other important thing to note is there are contribution limits per year. So if you just Google HSA contribution limit, 2021 or 2020 or whatever year it is, you just put in contribution limit for HSA for the year, and then you'll easily be able to find that. Same thing for the FSA. All right, so advantages. What are some advantages of these different types of accounts? Well, for the HSA, they are tax deductible contributions. So if you put in, let's say that you earn $100,000 in 1 year, just to make numbers easy. If you earn $100,000 and you contribute $3,000 to your HSA, your taxable income is only $97,000. So you actually pay less in taxes because your taxable income is lower. So they're tax deductible contributions. Then you can use pre-tax dollars for qualified medical expenses, which is the purpose of the account. So that's the advantage. But also for the HSA, what's important is unused money rolls forward. Unused money rolls forward. If you put in $3,000 and you do not use, let's say you only use $500 that year, well, at the end of the year, you still have $2,500 in that HSA account. Well, the following year, your beginning balance is $2,500. In an FSA, it's use it or lose it. So if you put in $3,000 into your FSA and you don't use it, well, the next year it's gone. You don't have it anymore. So that's a huge difference between an HSA and an FSA. Now, also for the HSA is because you own it, if you move from one company to another, you keep the account. You still have the same account. It doesn't disappear. It doesn't vanish. You don't have to change accounts. You keep it even regardless of your job changes or retirement, whatever, no matter what, it's your account and you keep it. And also because of that is the second highlighted part here is you can invest the money and compound your savings. So in your HSA, over and above some limit, so it's going to be like 1,000 or 1,500 or 2,000 or some, I don't know what that specific limit is, but over and above a certain amount, let's just make numbers easy. Again, let's say it's 1,000. If you have, let's say $5,000 in your HSA, well, if the limit's 1,000, then anything above 1,000 you can then invest and grow over time. So that means you could put $4,000 into index funds and grow that money over 3, 5, 10, 20, 30 years, just like you would any other type of investment. So that's really awesome that you can do that with the HSA. You keep the money regardless of where you go, and you can invest it and continue to compound your pre-tax dollars over time. Awesome. So you can use the money. The last advantage for the HSA is, let's say that you have a growing amount in there and you haven't used it all before age 65. Well, after age 65, once you turn 65, the government says, one, you can continue to use that money for qualified medical expenses and not have to pay taxes on it. So just like you have before for the first 40 years of your life. But then also, two, is because you're now 65 and we understand you're looking to retire, if you want to access this money as normal income, all you need to do is pay normal taxes on it. But you can actually pull the money out of the account, pay taxes on it, and then you access it like normal income. So that's pretty cool. Now for the FSA, the two main benefits are it's tax deductible just like the HSA, and then you can use pre-tax dollars for medical expenses just like the HSA. But again, the big caveat with the FSA is if you don't use it, you lose it. Now for the HRA, the major advantages are it's the employer's money. It's not yours. It's the company's money. And you are reimbursed by the employer for qualified medical expenses. So rather than you sometimes, you might have to pay for it initially, but then you bring the receipt in to your employer and then they reimburse you. Or And we'll talk about this on the next slide. But sometimes for all three of these, you'll just be given a debit card and you just use that debit card like you normally would any other debit card, except it's accessing funds from those accounts. And then finally is, depending on the HRA plan, you may also be able to set up your own HSA account. So that's pretty cool too. So you have not only the company's money to use for your medical expenses, but some companies, in addition to that, will also say, hey, we understand that you want to be putting money aside for yourself for medical expenses. You can also create an HSA. All right, so those are the three. Now, in terms of requirements, well, for an HSA, the employee must be enrolled in a high deductible health plan. For an FSA, your employer must offer you, the employee, a group health plan through company benefits package. So through their company benefits package. Now, for the HRA, the employer must also offer this to the employees. I mean, not every company offers this. So if they don't offer it, then it's just not accessible to you. But it can also be used for any health plan. Okay, so how do you use it? So if you do have an HSA, how do you actually use that to pay for your vision bills or your dentist bills or medical bills or prescription drugs, anything like that? So for your HSA, they'll actually send you a card, like a debit card in the mail, and you just use it like you would any other account. And then usually for the FSA, same thing. You get a debit card that you use that's linked to the account. And then for an HRA, it's either you're going to receive a debit card or all you'll need to do is save and then present the receipts to the company and they'll reimburse you into your checking account. So I'm not a healthcare, specialist. I'm not a health industry specialist. I'm not a health savings account specialist. This is me providing you with important high level information so that you can have an idea of what account should I be focused on and what account does my company offer and how do I want to make a decision about my health savings. Because you do want to be contributing money in some way, shape, or form. You want to put money aside for your medical expenses because they will happen. We are humans. We are mortal. We will have medical expenses. So read all of your health savings and your coverage options in the benefits package and always speak with a human resources contact to discuss options. Some people have the idea that, I'll just figure everything out myself. Even if you have figured everything out yourself, schedule a 30-minute conversation. That's it, 30 minutes with human resources, with one of the contacts there, and make sure that you are absolutely 100% positive you're making the best decision for yourself, for your family, and you know all of your options, and you've thought through everything, and you've heard it from the company themselves. So it doesn't hurt. 30 minutes, and you could be saving yourself a lot of pain. So how does health savings and coverage actually work? Some people, myself included, previously, I was like, I don't know how any of this stuff works. It's kind of like, what would happen if I broke my arm? What would my coverage do? What is my network? How much would I be paying? Like healthcare just seems like this crazy black box that a lot of people don't understand. So I want to make this super simple. And again, this is high level, but it will provide enough information that I hope you understand how these plans work. So your healthcare plan or your coverage is going to have several important factors. And the most important factors are these four. What is your deductible? What is your coinsurance breakdown? What is the max out of pocket that you'll need to pay? And then what is your healthcare network? So for these first three variables, the reason putting money aside into a health savings account, whether it's an HSA or an FSA, is, and the reason I didn't say HRA there is because the HRA, remember, it's only the company providing the money. So the only ones that you actually put your money into is the HSA or the FSA. So, but the reason you want to put money aside for health savings accounts is because that pre-tax money you're putting aside is going to be used to pay your deductibles, to pay your coinsurance, and to pay for anything that you need to pay for out of pocket medically. All right, so now I want to give an example of how this all kind of ties together. Let's say that your health plan for these first three, deductible, coinsurance, and maximum out of pocket, let's say that your deductible is $3,000, which means that when anything happens, you need to pay the first $3,000. Well, then your coinsurance is, in this example, it's an 80%, 20% split. Now, what that means is any expense over and above your deductible, your insurance company will pay 80% of that, and you will pay 20% of that. And now for the entire year, all of your medical expenses combined, your maximum out-of-pocket number, that $6,000, means that no matter what, the maximum amount you will ever pay out of pocket for that year is $6,000. Any expense above $6,000, your insurance companies, your health insurance will 100% cover it. So you may have heard, whether in your family or maybe you were the one who knew this, but maybe in July or August or September, you hit your maximum out-of-pocket number, and then for the rest of the year, you're like, oh, let's go get blood tests. Let's go get like my eyes checked. And then you're like, let's do everything we need to do because we've already hit our max out of pocket. We're not going to be paying for it. The insurance companies are. So once you hit your max out of pocket, no more money is coming out from you. It's going to be for the rest of the year or whatever the time frame remains. Once you hit that max out of pocket, the insurance company pays everything over and above that. All right. So as an example of how this health plan would actually work, let's say that you have a medical emergency and God forbid this happens. Let's hope it never does. Let's say that you break your arm. Well, breaking a bone is very expensive and it's a lot more expensive than people expect. Now, is it going to be 20 grand? I don't know, but this is just an example. So let's say the total medical bill is $20,000. If you're in network, because again, where we said here, the fourth variable here was healthcare network. If you're in network, you get a healthcare network discount. That's why when people say, are you in network or out of network? The reason it's so important to make sure you're in network is because when you're in network, there are very large incentives and discounts to be in network. So let's assume that this is in network and you get a 50% discount. All right, well, that means that your final medical bill is going to be $10,000. So this $10,000 has to be broken down and paid for. Well, the first money that's go to this $10,000 is your deductible. So your deductible is $3,000. So that means you will pay the first $3,000. So after you pay that deductible, it means that there's $7,000 left. Well, that $7,000 is going to be split between you and the insurance company. And the split is the coinsurance split. So 80% of that $7,000 is going to be paid for by the insurance companies, and 20% of that $7,000 is going to be paid by you. So your 20% of the coinsurance after the deductible, so 20% of $7,000 is $1,400. So your total out-of-pocket money paid for this medical bill, the $10,000, is $4,400 because you paid the $3,000 deductible and you paid the 20% of the remainder $7,000, which is $1,400. So $3,000 plus $1,400 is $4,400. Now, that means that the insurance company paid the remaining 80% of the $7,000, which is $5,600. Now, what does that mean going forward? Well, you have a remaining balance within your maximum out of pocket. You still have some money to pay for the rest of the year before your insurance companies will pay for everything else. So you know that your max annual out of pocket is $6,000. Well, for this broken arm, you paid out of your pocket $4,400. So that means that if anything else happens for the rest of the year, you will still need to pay $1,600 before your insurance companies will fully cover everything else. So I hope all that makes sense. And if it doesn't, kind of rewatch this series because I know sometimes I can lose people in the weeds here. But the math itself is not rocket science. I promise you, you can understand this. It's just those three variables, your deductible, your coinsurance, and your max out of pocket, those are going to heavily influence how much money you're actually using for your medical expenses. So the money that you're paying out of pocket, that's why you want to have this health savings account and be putting aside pre-tax dollars because you're going to be able to use pre-tax dollars for these medical expenses, which will save you literally 20 to 40% of your money. It's very important. All right, so Now, in terms of healthcare networks, I'm not going to go deep in the weeds on this, but I want to provide an overview of kind of the four main networks. So a PPO is a preferred provider organization. And what a PPO is it means that there's no referral required in order to go see a specialist. So now let's say that you have your pediatrician, or I'm sorry, not your pediatrician, your primary physician. And let's say that you have a back problem and you want to go see a back specialist who specializes in spinal problems. Well, if you're in a PPO, you do not require a referral. So you can actually go straight to that spinal surgeon or that spinal doctor who's in network for you, and you can go meet with that doctor without having to get a referral. Whereas, for example, in HMO, a referral is required. So in an HMO, in order to see that spinal doctor and have it covered, you would first need to go to your primary care physician, tell your primary care physician, whether it's a guy or girl, and you'd let them know, these are the problems I'm having. And then your physician would say, okay, I'm going to refer you to this specialist. Well, that's what a referral is. All right, so back to the PPO. So you have coverage both in and out of network, which means that your healthcare insurance will kick in whether you're in network or out of network. But the only difference is if you are out of network, it will be more expensive. And that also means because you can go in or out, it's also the most flexible because you can go in or out and still have some of the network discount. But because it is flexible and it does provide, one, there's no referral required, and two, you can be both in and out of network. Well, that you're paying for that flexibility, which is why the premiums are the highest. Now, for an HMO, you do require referral. There's no out of network coverage, and it's not very flexible. Well, because of that, you're going to be paying lower premiums, but it's a lot less flexible. So now there's kind of these bottom two are more of blends, the EPO and the POS. So EPO is exclusive provider organization. And going back, I didn't read HMO. So HMO is the Health Maintenance Organization Plan or network. And then EPO is the exclusive provider organization. So EPO is a blend of PPO and HMO. And so as you can see, the EPO is similar to the PPO because there's no referral required. However, it's also similar to the HMO because the second bullet point is there's no out-of-network coverage, which means it's not as flexible. And because it blends the PPO and the HMO, there's about medium premiums. Now the POS, point of service, not piece of shit, POS, it's similar to the HMO and it's also slightly similar to the PPO. So how the POS is similar to the HMO is it does require a referral, but it's similar to the PPO in the sense that there's coverage both in and out of network. But the reason it's only somewhat flexible is in order to go out of network, you can only go out of network with a referral. So that's the blend between the HMO and the PPO. And then again, the POS, just like the EPO, because it's a blend, there's medium premiums. It's not the highest and it's not the lowest, it's medium. All right, so speak with a healthcare professional at your company. Determine the best healthcare plan and savings account for you and your family, your dependents. But all this stuff, I know that a lot of people just turned a blind eye to healthcare because they're like, there's too much going on. I don't know what's happening. Do the due diligence, know what you're enrolled in, know your accounts, make the decisions for yourself, seek the information you need. It's so important that you know what's going on with your healthcare and your health savings plans. Okay, so now let's talk about investment accounts. So an investment account is an account used for compounding your money, either in the short term or the long term, by purchasing or contributing money to investment assets or by lending money to people, businesses, and governments to earn interest. And these accounts may be either tax advantaged or non-tax advantaged. So in terms of tax advantaged accounts, as we already talked about for the health savings accounts, tax advantaged accounts are important because they save you money on taxes. Now, if an account is tax advantaged, you have one of two options. One type of tax advantaged is you're using pre-tax dollars, you're investing pre-tax dollars, but anything that you earn, so earnings, later on in the future, when you pull out the earnings, you have to pay taxes on the earnings then. But the other option is you pay taxes on your income now, you invest after-tax dollars, and which means that later on, as you earn money over 1 year, 2 year, 5 year, 10 year, 20 year, 30 year, 50 year, whatever, when you pull that money out, you do not have to pay taxes on your earnings. So again, there's two options for tax advantaged accounts. One is you're not paying money on your, or you're not paying taxes on your income now, and you're using that money today, and you're investing pre-tax dollars today, but you're going to need to pay taxes on your earnings in the future. Or you're investing after-tax dollars today, but in the future, you're not going to have to pay taxes on your earnings, your investment earnings. Awesome. So one of two choices. So now I want to break down what that might look like in terms of financial benefit in the future. So a non-tax advantaged account, you can see here that let's assume that from your job, you're taking home, your monthly taxable income is $6,700. Well, before that hits your checking account, your company is going to take out taxes. So if your taxable income is $6,700, let's just say that your federal taxes would be, call it $920. Your FICA taxes, which is Social Security and Medicare, would be $520. And then your state taxes might be $280. So your actual monthly after-tax income would be roughly $5,000, so $4,980. That's the amount that would hit your checking account. Well, if you're investing after-tax dollars, it's going to be after you've paid taxes. So then let's assume that you do monthly after-tax investment contribution of $750 a month. Well, that means that you've invested $750, and overall, after you've invested that, you now have $4,230 left for your life. Well, that's $750 of after-tax money. Let's assume that you do that monthly, $750 a month, and you're earning 8% on that money for 30 years. Well, 30 years from now, that after-tax money would have grown to, with the investment earnings, it would have grown to $1,019,000. Well, if you want to use that money and pull that out in the future, let's say you're retired and now you want to use that money to live on, well, as you pull out those earnings, you're going to need to pay taxes on those earnings. So you can see here, you're paying double taxes. You're paying taxes on the money that you're earning, and then you're investing after-tax dollars. But then 30 years in the future, when you pull that money out, the earnings out, you have to pay taxes again. That is a non-tax advantaged account. But now let's compare that to a pre-tax advantaged account. So remember, this is the first of the two types of tax advantaged accounts, pre-tax contributions. So let's pretend that the $750, you still want to invest $750. Well, in a pre-tax contribution account, you're going to have your $6,700 that you earn from the company. Well, before you pay any taxes to the government, you're going to be able to contribute money to your pre-tax contribution tax advantage account, which means that your adjusted monthly taxable income is actually going to be lower. So you'll only have to pay taxes to the government on $5,950. So then your federal taxes are going to be lower, your FICA taxes are going to be lower, your state taxes are going to be lower, and your monthly after-tax income is going to be $4,423. And because you're not investing after-tax dollars, your monthly after-tax income is going to be the same as your take-home income. So you're taking home $4,423, which is $193 more than before. And you've invested $750 still. So it's kind of like you just got $193 of tax benefit, which you did. So now those pre-tax dollars that you've invested are going to be in your investment account. And let's say, again, you're contributing $750 a month at 8% ROI, or you're earning 8% return on investment over 30 years. Well, you're still going to end up with $1 million. But at the end, you're still going to have to pay taxes. So you did not pay taxes in the beginning, and you ended up with a benefit of $193 today, but you still had to pay taxes at the end. This is a pre-tax contribution, tax advantage account. Now you can see the benefit is $193 today. So you can either keep that $193 in your pocket today and spend it uselessly, or what you can do is increase your pre-tax contribution amount, which is what's recommended because that's the primary benefit. So if you increase from $750 a month to $943 a month, well, afterwards, you're going to end up with the same take home as the first scenario. You're going to end up with $4,230 a month that you're taking home and it's hitting your checking account. But you've invested $943 pre-tax. So what that means is rather than $750 a month, you're contributing $943 a month. And let's assume that you're still making the 8% over 30 years. Well, you're now at $1,281,000. You're $262,000 higher at the end of 30 years. And it's because you maximized the pre-tax advantage. So, are you still going to have to pay taxes when you pull that money out in the future? Yes. So let's say 30 years from now when you're retired, you want to pull out $50,000 annually to cover cost of living expenses. Well, you're still going to have to pay taxes on the $50,000. So let's say it's 20% taxes. You're going to walk away, 30 years from now or 40 years from now, whatever, with $40,000 when you pull that out. But I hope that all this kind of you can see the benefit of using and investing pre-tax dollars and not having to pay taxes in the front end. So this is one type of tax advantage account. Now, the thought here is if you don't pay taxes today, you do risk having to pay higher taxes in the future. And this is if you ever have a conversation with someone and they say, well, if you don't pay taxes now, then you're going to have to pay taxes in the future. The question is, what do you think taxes will be in the future? Are taxes going to be higher in the future? Is the government going to raise taxes in the future? So if you're young in your career right now, kind of consensus thoughts are, well, most people believe that the government will raise taxes in the future. So if we're in our 20s and 30s, well, most likely we're going to be paying higher taxes in the future. Now, let's say you're older, maybe in your 50s or 60s. Well, maybe you'd rather not pay taxes right now, and maybe you would rather pay taxes in the future because you're only going to be withdrawing a small amount of money. Maybe it's 40 grand a year, 50 grand a year, 60 grand a year. So there's different decisions about whether or not to do a pre-tax or an after-tax tax advantage account. But this example on screen right here, this was pre-tax contributions. This is like a traditional retirement account, traditional 401k, traditional IRA, and we'll talk about that. So now let's talk about after-tax. So after-tax contributions. Well, you can see here that just like the non-tax advantage, you're paying taxes immediately. So if you earn $6,700, you're going to pay full taxes on that, which means you're bringing home $4,980. You're still contributing after-tax contributions of $750. So that means you're going to be investing $750 for 8% for 30 years. You end up with $1,019,000, but you're not paying taxes on the money, the earnings that you withdraw in the future, 30 years from now. So this would be an example of a Roth 401k, a Roth IRA, after-tax contributions. You're investing after-tax dollars. So in this scenario, you're paying taxes today, but you don't pay taxes in the future. So if we were to lay out the different types of accounts on one page, non-tax advantaged versus tax advantaged accounts, in the non-tax advantaged, you would have your checking account, which is, again, that's more of like your operating account. Money goes in and then you need to decide how to use it, where it goes. So it's for receiving and moving money, deposits, withdrawals, and transfers. And there's a very high limit, whether it's $250 a month or $500 a month, whatever. Then there's your savings account for holding money, receiving minimal interest, and beating inflation, not losing money and not losing buying power over time. And then the third is a brokerage account. And this is an investment account. So a brokerage account, it might be through Schwab or through Fidelity or through TD Ameritrade or through any of these other institutions. But a brokerage account, all it means is you're contributing after-tax dollars, and any money that you make on your investments, you're paying taxes later on the earnings too. So you're using after-tax dollars, you've paid your taxes today, and you're going to pay taxes in the future. So it's non-tax advantaged. So that's also used for investing and growing your money with public and private investments. So now let's talk about the tax advantage and lay those out. So the very first type of tax advantage accounts we have are retirement accounts. So we have 401ks, 403bs, and 457 plans. Now, all of these, they're created for the same reason. And the only reason it's called 401k or 403b or 457, those numbers literally just come out of the IRS tax code. It's just referencing a certain portion of the tax code. So a 401k is if you work for a for-profit corporation, a for-profit company, or a for-profit organization. So if you're working with a company that's making money and it's not a nonprofit or a charity, that's why you have a 401k plan. Now, if you're working for a nonprofit or a charity, you're going to have a 403b plan. And it's the exact same type of purpose as a 401k. It's for long-term retirement. If you're working for the state or if you're working for the government or some other similar type of institution, well, you might have what's called a 457 plan. But again, all three of these are for the same purpose. They're employer-sponsored retirement plans, and they can be either traditional or Roth. But then you have an IRA. An IRA is an individual retirement account, an individually managed retirement account. So you are setting up your own retirement account. It's not with the company. It's not with an organization. It's you yourself managed. And similarly, you get to choose whether you want to do after-tax contributions or pre-tax contributions. So you choose what type of tax advantage account you want. So tax advantage retirement accounts may be either traditional or Roth. Now, if you're choosing a traditional, and a lot of people don't know that 401ks can be Roths. A lot of people just say, oh, I signed up for my 401k. Well, by default, most companies default to traditional 401ks, but you can see, and many companies do offer Roth. So traditional just means that you're using pre-tax money today, and when you pull the money out 30 years from now or 20 years from now, whatever, you'll need to pay taxes later. A Roth account, whether it's Roth IRA or Roth 401k or Roth 403b, whatever, you're investing after-tax money today, and you're not going to have to pay taxes in the future. So that is the difference between traditional and Roth accounts. It's not complex. That is it. Are you using pre-tax money or after-tax money to invest? When are you paying taxes? Okay. So the other thing I want to talk about for the 401k or for the IRA is in your IRA, you're going to be able to choose all of your own investments. You have full 100% control over your investments in your IRA. In your 401k, you're going to have a menu. Your company creates a menu of investments for whatever your retirement account, whether it's 401k, 403b, or 457. It's kind of like, imagine yourself walking into a restaurant and the restaurant says, we cannot cook anything you want. This is our menu, and you get 50 options, which is still pretty decent, but these are the only options we're offering. Well, there's not infinite, but there's thousands of options for investments that you can choose from. There's different funds, there's different types of specific stocks, there's different target date funds, and we'll talk about that. But in an IRA, you can choose anything that you want. You have 100% control. A 401k or an employer-sponsored retirement account, they're going to give you a menu. That's the biggest difference between the 401k or an employer-sponsored account and an IRA. They limit what you can choose to invest in. But usually the menus are still pretty expansive. All right, so now other tax advantage accounts, as we already talked about, your health savings accounts. So whether it's an FSA or an HSA, you're using pre-tax dollars in those accounts, which is great. And FSA is going to be employer-sponsored, as we talked about, versus the HSA is you're individually managing it, and you can also invest that money and roll it forward and keep it going forward. And then there's the education accounts. And a lot of people don't know that there are education tax advantage accounts. So if you have kids, or if you're thinking about having kids, or if you're married and that you're going to be needing to set aside money for education expenses for your kids in the future, well, there are education tax advantaged accounts that are after-tax contributions. So that means that after you receive your money from your company or whatever, you've paid your taxes, and now the money's in your checking account, you can set up a tax-advantaged 529 or an ESA, which are education accounts, using after-tax money today, and invest it. And let's say 15 years from now or 20 years from now, that money has grown. You've earned a lot of investment income. You've created a good return on that money. Well, you can then pull that money out 20 years from now to pay for your kids' education or even your own education and use it all for your education expense and not have to pay taxes on that money. So that's the tax advantage account for education. So this is, again, a high-level overview of non-tax advantaged accounts versus tax advantaged accounts and the benefits that the tax advantage accounts provide. So in terms of what would a strategy look like for thinking about how to maximize these tax advantaged accounts? Well, for your employer-sponsored accounts, so whether that's a 401k, a 403b, or a 457, your investment options are limited. So oftentimes, the companies or the organizations will also offer an employer match. So they say, we will match you up to $3,000, or we will match you up to $4,000, or $5,000, $6,000, whatever, $10,000. You'd be crazy not to take advantage of that, because it is literally them saying, hey, we know that we pay you X amount in salary, but if you put money into this plan, we'll also give you, X $1,000 complete for free. It is free money. And it's not only if they say, all right, we'll match you $3,000 this year, really what they're saying is we're going to give you an extra, $15,000, $30,000 because that $3,000 is going to grow over 30 years, over 20 years. That's free money that is going to compound for you and work for you for 15 to 30 years or longer. That's a lot of free money. So if your employer match is available, be sure to take full advantage of your employer match. All right. After you've taken full advantage of the employer match, well, then you want to max out your IRA because, again, you have more control over your IRA. You can choose all of your investments, all of your own strategies. You're not limited. So it's kind of like take advantage of the employer's money. But then after you've taken full advantage of that, you then want to start contributing to the IRA because you have full control over that. And then your HSA is you do want to put money towards your health savings account. And then after you've allocated money to your IRA and your HSA, well, then you still likely have some room available for your employer-sponsored retirement account or other tax advantage accounts. So, all right, go ahead and do your best to take more advantage of those. And then after you've taken advantage of your tax advantaged accounts, well, if you still have more money to invest, and you really do need to make quite a bit of money to max out all of your tax advantage accounts, well, if you still have excess money, you don't want it just sitting there doing nothing. The worst thing you could do is have it sitting in your checking account. The next kind of not as bad thing to do is just put it in a savings account, because if you're just putting all of the money that you should be investing in a savings account, it's not going to grow. So the other thing you could do is then if you still have excess money that you want to invest, either invest it through a brokerage account, which is a non-tax advantaged investment account, or put it into private investments. That could be real estate. It could be investing in a private business. It could be lending to someone specifically. And we'll talk about those types of options later on. But kind of those are this last fourth option is these are going to be non-tax advantaged. So understanding the purposes of each account is crucial between your checking account, your savings account, and your investment accounts. Understanding the tax differences between accounts is crucial. Is an account tax advantaged or is it non-tax advantaged? And if it is tax advantaged, is it a pre-tax contribution or is it an after-tax contribution? And then finally is understand your investment options. How can I actually grow my money? And that's kind of what this next part is going to be talking about, public investments and private investments. Now, again, I'm a coach. I'm providing information and training. I'm not recommending anything. I'm not advising anything. I'm providing information for you to be able to understand the different options that are available, and then for you to be able to make your own decision with information that is going to be available to you, that I'm providing. All right, so public investments. Public investments are investments that are traded and bought and sold in the global financial markets. Now, if something is a public investment, it means that it's going to be regulated by the government securities agencies in each country. So in America, we have the SEC. In Europe, they have their own agencies. In Asia, in different countries of Asia, they have their own agencies. So if something is publicly traded on the global financial markets, it's going to be regulated. Now, what a public investment is usually one of two things. You're investing ownership in buying ownership in a public company or a public asset, or you're lending money to a public company or to a bank or to a government. So you can lend money to, and what's crazy about public investments is you really can invest in pretty much anything that you want. If you really wanted to, you could invest in Japanese government bonds. You could invest in European, like French government bonds. You could invest in Greek government bonds. And those, that's a different story. But so you can invest in governments. You can lend money to governments. You can buy companies. You can buy European companies. You can buy Asian companies. You can buy, African companies. The world is your oyster. And once you understand like, wow, I can do that, it's kind of super expanding and realizing like I can invest in anything that I want because the global markets are all connected. But at the same time, it's also scary because then it's like, oh my gosh, what do I put my money into? But the first most important thing is to realize you really do have an option to invest in pretty much anything that you want as long as it's publicly traded. And if it's publicly traded, you can literally buy it online or invest online. So it's difficult to successfully invest in specific companies, assets, or loans or bonds without taking too much risk and potentially losing your money. And the reason it's more risky if you're choosing a specific investment is because it does require deep skill, knowledge, and experience to successfully research and select individual investments. And this is really what we focused on in part one when we talked about diversifying risk as opposed to taking one specific bet. And that's where, for public investments, one of the ways that you can make more money more often than you lose money is through risk management, which is diversifying your public market investments across a group of investments. And what that does is it reduces your risk while still capturing returns across many companies and different assets. So for public market investments, can you invest in specific companies? Absolutely. Yes, you can. But it's riskier. So the way that if we're not a super skilled, experienced, expert investor, which many retail investors are not, one of the ways that we can still invest and win over the long term is through diversification. We'll still capture returns, but we're greatly reducing our risk because we're managing it. So in terms of how you could get a structure, a framework for thinking about public investments, I like to use this triangle. So at the bottom, think of this as at the bottom is very granular, everything specific. You can choose specific stocks. You can invest in Nike or Amazon or Facebook or Procter & Gamble or Target or Walmart or Johnson & Johnson. Like you can choose all these individual companies. And I just named big companies. I mean, there's thousands of small companies too. So you can choose very granular, specific individual investments in stocks, in companies. But you can also choose very individual bonds and lend money to very specific companies or organizations or governments. And then real assets. So real assets could be oil, grain, plutonium, gold, silver, meat. It could be real estate. It could be commercial real estate. It could be residential real estate. It could be, Caribbean 5-star resorts. There's so many different things that you can invest in particularly. So kind of on the right side where I have the bullet points, if you're choosing individual investments, it's going to be higher risk, but there is still the possibility of a higher reward. And that's the trade-off. Higher risk equals higher reward. But it also means bigger losses. And you're choosing specific investments. And if you're going to choose something at a granular individual level, it does require skill. Because if you get an investment wrong, if you're only choosing one or two specific investments and those two go bad, you've lost all your money. And then you've lost the money that you need to grow. So at this first lower level, very specific, you choose everything, granular level investing, but it is higher risk. So then there's the middle level, which is diversification. This is where diversification first comes in. So you have index funds and mutual funds, and think of a fund is nothing more than, think of it like a basket. If you were to take 10 companies and put them into one basket, you now have a fund. So a fund is a basket of investments. It could be a basket of stocks, it could be a basket of bonds, or it could be a basket of real assets. So these funds diversify and they manage and reduce risk. Because let's say that you choose 10 companies. Well, what if 4 of those companies go poorly? Well, you still have 6 other companies in the fund, in the basket, that did well. So you still make money. So that is the benefit of a fund. You're diversifying across a group of investments. And these funds, you get to choose what kind of funds you want. You could choose a fund based on an asset class, like stocks or bonds or real estate or commodities. Or you could choose a fund based on geography, like US stock market or French stock market or German stock market or European stock market. Or you could choose it by industry. You could invest in a fund that is a basket of pharmaceutical companies or consumer goods companies or technology companies. So you could have funds by industry, or you could have funds by size. So the top 300 largest companies, the top 500 largest companies. Or you could do a fund based on risk. And there's different types of risk. Risky companies, high risk companies, low risk companies, mature companies, growth companies, etc. So funds, you can choose what you want your fund to be made of, composed of. And then the last part is these funds have a benchmark. So a benchmark means that this fund is going to be tracking a portfolio of investments. So it needs to either perform in line with the benchmark, or it's trying to beat the benchmark. Now, an index fund, or actually, sorry, I'm not going to dive into that yet. I want to cover one last part. So the top here is a target date fund. So if the middle part, index funds and mutual funds, this middle part of the triangle, if that is a basket of companies or a basket of bonds, a basket of real assets, a basket of individual investments, the top of the pyramid, the target date funds, is a basket of funds. So it's one big basket with a bunch of smaller baskets within it. So a target date fund is a really big basket with index funds and mutual funds within that one basket. So it's a fund of funds. It's literally big basket with many smaller baskets in it, a fund of funds. So it's a basket of diversified index and mutual funds, and it adjusts allocation annually to reduce risk return and has fixed allocations and investments. So what this means is a target date fund. The reason it has that name is let's say you just graduated college, you're 22 years old, and you know that 30 years from now or 40 years from now, you want to retire. So what you're going to do is you're going to choose a target date fund that is 40 years in the future, and that's the fund that you would allocate money to. So that might be, so for example, right now it's 2021. So 30 years from now, maybe you decide to choose the 2051 target date fund, and you start allocating money to the 2051 target date fund. Well, because you're so young right now, that target date fund knows it should be more leaning towards equity and have higher exposure, which is, higher risk, higher reward. But you have 30 years to make up for any losses, so you can take that risk. But let's say that you now are 25 years into the future. So 25 years from now, there's only 5 years left of this fund. Well, it's going to significantly reduce the amount of equity, and it's going to increase the amount of fixed income, which is bonds, loans, less risky investments. And that's because if you lose, if they were to do something crazy and lose all your money, well, you only have 5 years left. So a target date fund automatically adjusts the allocation percentage. So I hope this triangle helps paint a really clear picture of what type of public investments are out there and gives you a lot of context behind at what level do I want to think about putting my money. Now, in my opinion, and again, I'm here to provide information. This is not a recommendation in any way, shape, or form. So, in my opinion, what I believe based on the differences between the bottom level and the very top level is the middle level provides the most control. And you can choose your specific type of diversified investments and choose how you want to manage your own risk. And it's the reason, I'm personally interested in this. Again, just me. What do I do? What do I think about? I like this middle part because I don't necessarily like how all of the target date funds are structured. And the reason for that is because there's a big difference between index funds and mutual funds. Target date funds often have quite a few mutual funds in them. So an index fund is different from a mutual fund because an index fund is passively managed. A mutual fund is actively managed. A passively managed fund means that it's a bunch of computers that are running the algorithm, and all it's trying to do is match the market. So as an example, you may have heard the S&P 500 or the Dow Jones. Those are just indexes to judge how well the economy is doing. They're literally just thermometers for the economy. So if we didn't have those indexes, if we did not have the S&P 500 or the Dow Jones, people would say, well, I wonder how U.S. businesses are doing. Well, they wouldn't have any thermometer to know how our economy is doing. So what they did is they took, the S&P 500 is 500 of the largest U.S. companies, and they literally take a temperature or a thermometer read on how are these companies doing day after day after day. Well, if these 500 companies on average all moved up 1%, well, that's why people say the S&P 500 moved up 1% today. And then if these companies on average fall 3%, well, people say the S&P 500 fell 3%. So it's a thermometer. Now, what an index fund does is an index fund will track the performance of the index. So the S&P 500 is the index itself. Well, what an index fund is going to do is the index fund is going to say, all right, well, if those 500 companies make up the S&P 500, what we're going to do as the fund is we're going to set up a portfolio that has the exact same size and allocation as those 500 companies in the index. So if the S&P 500 goes up 1%, our fund also goes up 1%. If it falls 3%, our index fund also falls 3%. So that's just one example using the S&P 500, but there are index funds that track many, many, many different types of indexes. Now, a mutual fund is actively managed, which means that there are humans running the portfolio. So these humans might be in New York, they might be in Chicago, they might be in Los Angeles or San Francisco, they might be in Houston. So there are physical people that have salaries that are actively buying and selling, which means that there's a lot of transaction cost and trading cost. And those people need resources. Those people need research. So there's a lot of, they also need an office and they need high salaries. So, and the thing that's crazy about mutual funds is, let's say that they're going to start a fund. Well, they might need $1 million or let's say $10 million to start the fund. Well, before they even invest $10 million, they pay themselves first. So no matter what, before they've made any money for you, you've given them your money. Before they've given you anything back, you've paid their salary, you've paid for their office, you've paid for their computers, you've paid for their research. You have paid for everything for them. They literally don't have any risk. In terms of, hopefully they have their money where their mouth is. Hopefully their money's in the fund too. But oftentimes there are mutual fund managers who don't have their money in the fund. So for them, it's literally you're giving them the money that they're taking risk with, and you're the one brunting all the risk, and you're paying for it. So mutual funds, because of all this overhead and human expense, the costs are a lot higher. Whereas, again, going back to an index fund, because it's just computers tracking the market and they're not constantly buying and selling, you're not paying for their office, you're not paying for their salaries, you're not paying their high bonuses. Well, the cost for an index fund is really, really low. Now, in terms of what does that mean, and this is not a recommendation, but in terms of information for performance, who historically has a better performance and returns a better return over the long term, undoubtedly it has been index funds. Now, I want to show why that has been. So in terms of the cost of fund, and this is, if you remember in the very beginning of this video, I said we're going to talk about index funds and mutual funds, And I promise you, this alone will save you over $100,000. For many of you, probably, for you, who knows? Maybe you're putting a lot of money in. You might save multiple hundreds of thousands of dollars. The cost that you're paying for your return is very, very, very important. So, as an example, let's say you have 8% here. So, in all of these examples, let's assume that you're returning 8% on your investments. Well, if your fund, and this is also not true because a lot of mutual funds underperform the market, which we'll show you. So it really wouldn't truly be 8% for all of them. But let's say theoretically that the mutual funds and the index funds all return 8%. Well, if you're going to pay a fund cost, and some mutual funds range from 1% to 3%, a couple are lower, but for the majority, most mutual funds are going to be between 1% to 3%. Well, if you're paying 3%, that means that your net return is going to be 8% minus 3% for 5%. Well, if you're earning 5% on your money, well, in year zero, you're assuming you're nothing, you start with $10,000, so total return on $10,000 over 30 years. So you start at $10,000, and if you're earning 5% over 30 years, that's going to compound to about $43,000. Well, now let's assume that you reduce the fund cost by 1%. So now you're only paying 2%. Well, 8% return minus the 2% cost is going to give you a net return of 6%. Well, if you're earning 6% on your $10,000 over 30 years, that's going to give you $57,000. Well, what if your fund cost is only 1%? You're netting 7, and that's going to give you $76,000 over 30 years. Now, in index fund, a lot of index funds, the cost is literally 0.1%. 0.05%, 0.5%. They're significantly lower than mutual funds. Well, that means that in this case, this fund cost is 0.1% or 10 basis points. So 8% minus 10 bips or 10 basis points is going to give you 7.9%. Well, if you have a compounding of 7.9% on 10,000, you're going to end up with about $98,000. So the cost alone, just by the cost, if you're paying 3%, you're losing more than half of your money over 30 years. That is substantial. And it's one of the wildest things within the financial industry, that people don't know that they're paying so much for certain funds, and they're literally, and the way that they market it too is tricky, because they'll say, yeah, only pay $3 for every $100 invested, and we'll manage your money. Well, most people think $3, oh, that's nothing, easy. $3 out of 100, yeah, sure, why not? Please, I have no idea what I'm doing. Go ahead, you invest my money for me for $3. Well, they're not saying 3%. That's what that is. It's just another way of wording it, and that's marketing. It's trickery. So always know, how much am I paying for my funds and how much am I paying for my investments? Because over the long run, this fund cost, if you're paying 2 to 3%, you're literally losing anywhere from 60 to 40% of your money overall. The difference between, this is only $10,000. Imagine if this was 1 million and this was 2 million. Well, that's a huge difference. All right, I know I'm going overboard on this point, but I can't stress enough how important this is. Know how much you're paying for your funds. So now, is this just me saying this? No, all of this is based on my research. So you can see here, this was a public report done by CNBC and S&P Dow Jones. So I want to read through this with you. So key takeaway points. Active managers who claim that they would do better during periods of heightened volatility are going to have to find another argument. For the 9th consecutive year, the majority, about 65% of large cap funds lagged, and when it says large cap funds, what they're talking about is large cap mutual funds, lagged the S&P 500 last year. After 10 years, 85% of these large cap funds underperformed the S&P 500, and after 15 years, 92% are trailing the index. So after 15 years, 92% of mutual funds underperform their index funds, the index, the market. So this week, S&P Dow Jones Indices released its annual report on how actively managed funds performed against their benchmarks. And the benchmark, think of the benchmark as the index, the market. So The conclusion is that active managers continue to show dismal performance against their passive benchmarks. For the 9th consecutive year, the majority, 65% of these large cap funds lagged the S&P 500 last year, and this is 2019. So you can see here that percent of large cap funds that underperform the S&P 500. Well, for 1 year, 65%. That's pretty bad. More than half of them suck after 1 year. And then 10 years, 85% suck, and then 15 years is 92% suck. So not only are you paying these people a lot of money, but they suck and they're underperforming. It's crazy. So then we have, this is not a 1 year phenomenon. S&P has been doing this study for 16 years, and the long-term results only strengthen the claims for index investing. Indeed, while a fund manager may outperform for a year or two, the outperformance does not persist. After 10 years, 85% of large cap funds underperform the S&P 500, and after 15 years, nearly 92% are trailing the index. So that's, again, what we talked about. So some people say, well, large cap versus small cap versus mid cap. This is what they're trying to show, is that it doesn't matter what kind of fund size they are. They underperform over the long term. So last 10 years. And remember, this is money that you're putting in for the long term. You're putting this money in for 10, 15, 20, 30 years. Well, my God, if 15 years, 92% of them are underperforming, imagine 30 years. It's probably 100%. So, critically, the study adjusts for survivorship bias. Before I keep reading, I want to talk about what survivorship bias is. Survivorship bias means that what you're seeing are only the survivors. They've excluded all of the bad funds from the past. So many funds, so I'm continuing to read here, many funds are liquidated because of poor performance. So the survivors give the appearance that the overall group is doing better than it really is. The disappearance of funds remains meaningful, the report notes. Over 15 years, 57% of domestic equity funds and 52% of all fixed income funds were merged or liquidated. So, breaking down what this means in just super easy to understand basic terms. Imagine that you were a basketball coach, and you are a basketball coach and you need to create a really great all-star team. Well, the first thing that you're going to do is you're going to take, and let's say you're going to groom, you're going to create these basketball players over 10 years. Well, you're going to find, let's say, 1,000 basketball players. And you have these 1,000 basketball players, and you start drilling all of them. You have them do basketball drills, you have them do conditioning, you have them do all the things that they need to do. Well, let's say after year one, you realize out of these 1,000 players, 100 of them are just totally uncoordinated. They can't shoot the ball. They're tripping on their laces. They can't tie their shoes. They're horrible. So boom, you kick out 100. You're now left with 900 basketball players. So now you still have 9 years. And let's say that in year 2, you continue to push them and you realize that 50 of these 900 they're just bad. They perform horribly in year 2. So now you kick out those 50. So now in year 3, you only have 850 basketball players left. All right, well now in year 3, you're continuing to coach them, you're continuing to do your best, and then you realize, all right, oh man, 150 of these got to go. They are just awful. So you kick them out, they underperform, and you kick them out, and now in year 4, you're left with 600 basketball players. Well, then you do the exact same thing. In year 4, you do your best, you try, and 300 of them just perform horribly. And you realize 300, this has got to go. Well, now in year 5, you're left with 300 out of 1,000, and on and on and on until year 10, you only have 15 basketball players. And then after you've put in all this time and effort, 15 out of 1,000 are actually good. Is that because you're the best manager, or is it because you literally survived and had to get through 985 basketball players to finally find the 15 that are good? And it took you 10 years to do that. The survivorship bias means that coach is then going to go around the country and market and tell everybody how great of a coach they are because they said, look at these 15 basketball players that I created. This is my track record. Look at these 15 basketball players. Look at how phenomenal of a coach I am. I created them. Well, what you don't see is you don't see the 985 basketball players that same person coached, but they sucked. That's survivorship bias. And in the industry, in the finance industry, what they're doing is they have the exact same thing. They'll create 1,000 funds. And then over time, most funds suck. And so the only ones that make it because they hit lucky for 3, 4, 5, 6 years, well, of course, those are the ones that they're marketing as 5-star funds and then charging really exorbitant fees for them because they're like, oh, look at our performance. Of course we can charge these fees. But the thing is they can't keep doing it for 10 years, 15 years, 20 years. Just like all the other funds, they're going to underperform. So it's super important to understand what is survivorship bias and how does it exist in the financial markets. Okay, so is this just me saying this? No, again, this is the research I've done, and I have 3 quotes here that I think summarize it perfectly from the world's best investors. So 1, Ray Dalio, he's the founder and the CIO of Bridgewater Associates, the world's largest hedge fund with over $100 billion in assets under management. And historically, he's been number 1, if not in the top 5, historically, like in all history, the best returns for hedge fund managers. And what he said is you're not going to beat the market. No one does, only a few gold medalists. So unless you're able to even get access to the gold medalists, essentially what he's saying is whoever you're giving your money to, they're not going to beat the market. Now, that's why the world's best investors are considered the world's best, is they are the few gold medalists. The Warren Buffetts, the Ray Dalios, like these people, and these people are so successful, you can't even give them your money anymore unless you're a part of their network or you're very well connected or you have so much money that for some reason that they'll open something up for you. But like Ray Dalio won't even take people's money anymore. So we can't even get access to him. So, and then what about Warren Buffett? Well, he's the founder of Berkshire Hathaway, and he's achieved, get this, a 50-year compounded annual growth rate, or a CAGR, of 19%. That is why Warren Buffett is Warren Buffett. He has done something that nobody has been able to do. For 50 years straight, he has dominated the market. That's Warren Buffett. All right, so what does he have to say? A low-cost index fund is the most sensible equity investment for the great majority of investors. By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. That's what he's saying is index funds over the long term outperform mutual funds. And mutual funds are managed by investment professionals. So low-cost index fund, you can outperform over the long term most investment professionals. So that's Warren Buffett. All right, now what about Jack Bogle, or John Jack Bogle? So he's the creator of index funds. He literally created index funds, and he's the founder of Vanguard, which is one of the world's largest investment companies. I'm sure you've probably heard of Vanguard. So his quote is, in terms of someone asked him, hey, as a retail investor, someone who's not skilled in investing, I don't watch the stock market, I don't read investments 24/7, what should I do with my money? So what he said was maximum diversification, minimal cost, maximum tax efficiency, low turnover, which means you're not trading consistently, low turnover cost. So if you do trade, it's a very low cost to trade, and there's no sales loads, which again are more fees. So low fee, low turnover, maximum diversification, maximum tax efficiency. All right. So for us, how can we think about this? Well, we want to use index funds for low cost diversification while capturing long-term market returns. And we want to diversify across asset classes as well as within asset classes. Now, when we diversify across asset classes, that's called asset allocation. Now, when we diversify within asset classes, that's why we want funds, because funds are diversifying inside of an asset class. Now, I'm going to show you this crazy, ridiculous looking table, but it is, so kind of what I have here on the slide right now is the Callan periodic table of investment returns from 2000 to 2019. So you can see at the top where it says the Callan's periodic table of investment returns depicts annual returns for 8 asset classes. So all these dots are showing these colors. These are 8 different asset classes. So now this next page, what it's showing is the return profiles for these different asset classes. And you can see it's a crazy checkerboard. There's really no specific pattern in these asset classes. So a lot of fund managers think that they can choose which asset class is going to outperform and which will underperform in any given year, which is called timing the market, trying to time the market. Well, some very, very, very few people can. Examples, Warren Buffett, Ray Dalio, and the other gold medalists. But most people are not that good. And that's why they're not so well known. So in terms of if someone is trying to choose one specific asset class or is only invested in one specific asset class, they're exposing themselves to asset class risk. So as an example, you can see here in 2007, emerging market equities were up, 39%. But then when the Great Recession hit in 2008, they were down 53%. Well, what's another case? Well, in 2008, US fixed income was up by 5%. And then, up by 6%, but it underperformed all of the other asset classes. And then what about, let's see here. So we have in 2013, so developed ex-US equity. Now what that means is developed nations, so think Europe and developed nations across Asia. Equity, so those are companies or stocks, and it's ex-US. So this is excluding US equities, excluding US stock market. So this could be, call this, European stocks and Asian stocks that are developed. Well, in 2013, they performed 21%, but then in 2014, they lost 4%. So that asset class did really well one year and then really poorly the next year. So again, it's very difficult to choose what asset class is going to do very well. So if someone only has their money in US stocks, well, then that means that when the US equity market goes down or up, their wealth, their investments are really volatile, and it's fluctuating heavily. So what we can do to mitigate that, to reduce that risk, is invest across asset classes and diversify across asset classes, which is called, again, asset allocation. Now, so this is asset classes. Now I want to show you an example of one asset class and how do we diversify within one asset class. So this is an example of a snapshot picture of the US stock market. So you can see here that all of these companies together make up the US stock market. And this is, only representative of some of the largest companies. You can see it gets super, 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 super small. Well, those are all the small companies. But you have industries within the US equity market, the US stock market. So we have technology, we have communication services, we have consumer cyclical. You can see here Amazon, Google, Facebook, Apple, Microsoft. We have financials like JP Morgan and Bank of America, Wells Fargo, Citigroup, and then we have credit services, which is Visa and MasterCard, American Express. And then we have healthcare like Johnson & Johnson and Pfizer. I think this is Eli Lilly, and then AbbVie. And then we have consumer cyclical, Home Depot, consumer defense, Procter & Gamble, Walmart, and then real estate. We have utilities, we have basic materials, energy, so medical devices, medical institutions, drug manufacturers, health, and then it gets really, really small. So you can see these are really large industries that can then be even broken down into even smaller sub-industries. So this is like the US economy in one snapshot. Well, these are all public companies. And because they're all US public companies, the asset class is US equities, US stock market. This is one asset class. Now, at the individual level, if you think back to that triangle, at the very, very bottom of the triangle, you can choose individual stocks. So you can pick any of these companies to invest in. But in the middle of the triangle, we talked about funds and how funds are a basket of the stocks, and that diversifies. Well, we can diversify within this asset class. We can diversify within the US stock market. So for example, I could buy or invest in a technology index fund. I can invest in a communication services index fund. I could invest in a healthcare index fund, a financial services index fund, a biotechnology index fund, an asset management index fund, an energy index fund, industrials, real estate. Like you can choose a fund of pretty much anything. You choose how you want to diversify your money. Or what you can do is buy a total US index fund, which diversifies across all the industries, all the companies of all sizes. Well, that would be the maximum diversification within the US stock market. So that would be an example of diversifying within the asset class. So ideally, kind of what we want to do is diversify across asset classes and within asset classes to reduce our risk and losses during market downturns while still capturing healthy market returns long term. But how do we do that? And that was the biggest question that I asked myself. That was the biggest question that I'm sure everybody asks. All right, well, that's great. Reduce risk, make money. How do we do that? Well, again, another disclaimer. I'm not recommending anything. This is information. This is research that I've done. This is information that I found. And these are things that I've implemented for myself, but I'm providing information for you to decide what is best for you. I'm not recommending anything. I'm not a wealth advisor. I'm not a wealth manager. Okay, so with that, I know you're probably sick of hearing me say that, but it's so important. Okay, so public investments. An example of a strategy that I found was when I was reading, so the book Money Master the Game by Tony Robbins. Highly recommend reading that book, and I also have that in the further reading section. But so really quick, the thesis of the book was that Tony Robbins spent 4 years interviewing the 40 best the 40 best investors who were all billionaires, and he only invested people who were self-made. So they started with less than $1 million, which is, it's still a lot of money, but they started with less than $1 million and then became billionaires. So that is turning a really, really small amount into a ridiculous amount of money. How did they do it? And what would those people recommend to us, retail investors, people who are not the best investors in the world? What should we be doing with our money? Well, in the interview with Ray Dalio had what was called his all seasons portfolio for minimizing risk and capturing market returns and still getting healthy returns across asset classes. Now, I'm not going to dive into how this portfolio works. If you really want to understand the underlyings and the intricacies between how he balanced risk in the different market environments, highly recommend, again, buying the book and reading it, because it is in there and it breaks down specifically why and how he created this portfolio. But in terms of like how I think about how do I put my money in, know that it's diversified across asset classes and within the asset classes, it's going to greatly reduce my risk and still produce a good solid return of between 7 to 10% most of the time. Well, it's Ray Dalio's strategy. He presented the strategy. So Ray Dalio, his, not mine, his recommendation was something along these lines. So long-term U.S. Treasuries, total intermediate U.S. Treasuries, and these are fixed income. These are U.S. government bonds, long-term U.S. government bonds. So think of these as 30-year U.S. government bonds, and then intermediate U.S. government bonds. So this could be anywhere from 7 to 20-year bonds. And then total U.S. equity market. So as I just showed here, investing and diversifying across the entire U.S. stock market, that's what this fund is, the total U.S. equity market. And then he said 7.5% of your portfolio should be in gold, and then 7.5% in a broad commodities basket. So in terms of actually doing this, like actually implementing this, what funds can we use? Well, these are index funds that are diversified across these. So for example, if I put 40% of my money into VGLT, which is a Vanguard government long-term treasury index fund, well, I'm only paying 0.05% to invest my money into this asset class. And VGIT is the ticker. So if you were to look this up in say your investment trading account or something, or to find this. So think of these, what a ticker is just like in order to buy Google stock, you would need to type in the ticker GOOG, or Apple is AAPL. Well, in order to find these index funds, you buy index funds just like you buy a stock. You just need to know the ticker and then invest just like you would any other company. So VGLT is for this fund, VGIT is for this fund, VTI is for the total U.S. equity market. It's a diversified index fund across the entire US equity market, and look at the fund cost, 0.03%. This is pretty much saying that if you can invest in the entire US stock market and the return of the market, you'll earn that less 0.03%. You're paying almost nothing to get the growth of the US stock market. And then for gold, it's 0.17%. And then for a broad commodities basket, and really what's within a broad commodities basket is a bunch of real assets. So commodities are real assets. So that could be gold, it could be silver, it could be plutonium, it could be iron, it could be meat, it could be grains, it could be cotton, it could be wheat, like anything that's it could be real estate. So there's all sorts of, and I take that back. Real estate would not be in commodities. Real estate would actually be in the U.S. equity market. That's where real estate would fall in this, because part of the U.S. equity market is going to be real estate investment trust, REITs. So REITs are nothing more than publicly traded real estate funds. So if you're invested in the total U.S. equity market, you are technically invested in real estate. So again, for more detail and information as to how and why Ray Dalio created this portfolio, this is not my portfolio, read Tony Robbins' book, Money Master the Game. Awesome. So Ray Dalio's all-season portfolio is a great option for long-term compounding for your security bucket and for your dream bucket investments. So think of that as retirement, for health savings, for education, for a wedding, for a second home, anything like that. Now, are you going to be making 30% on your money in a year in this, or some really, high return? No, but that's not the purpose of your security bucket. Your security bucket, the purpose of that is to consistently grow money between 5 to 10% year after year after year after year after year after year after year for 15, 20, 30 years. So that when you do want to retire, you have a large chunk of money that then you can then take that large chunk of money and put it into a money machine that's returning you 5% annually or 6% or 4%, whatever. But then that's going to produce the passive income that you need to live on for the rest of your life, all through retirement. So security bucket and dream bucket, you're really not looking for a lot of risk. You're looking for consistent, long-term, compounded returns. And this is an example of one strategy that is, from what the research I've done, it's a really great strategy for achieving this type of a goal. Now, for our growth bucket, you may decide to take more risk, and that could be choosing specific stocks, specific bonds, specific types of assets, or choosing to invest in specific private investments. So maybe that's where you accelerate your wealth building in the next 5 years or 10 years, something like that. So private investments, I'm not going to go too much into this, but I do want to provide an overview. So private investments are often riskier because they're not diversified. So you are taking individual risk in an investment. So what a private investment opportunities might look like is investing in or purchasing an investment asset. So for example, buying a real estate property, or lending money to someone to buy a real estate property. The second example is co-investing with a group in buying a business or a property or some other type of investment. So think of that as like pooling money with, literally, you could have 5 friends and all of you put in, say, $10,000, you have $50,000, and then together as a group, you buy one individual investment property. All right, well, that would be an example of co-investing with a group to buy a business or a property, whatever. But then the third example of a private investment is lending money to a private business, to an investor, or to some other type of individual, and then allowing those people to put your money to work, and then they pay you interest payments. So there's many, many different types of private investments. Now, if you remember from part 1, we talked about there are 3 really great strategies for managing risk. There's diversification, there's safety margin, and then there's hedging. Well, we know that diversification is a fantastic way to manage and reduce risk for public market investments, but because of the nature in private investments, we can't diversify. So that leaves the other 2 options of managing risk available. We can use safety margin. We can create safety margins, which again is making sure that you're buying something for less than you believe it's worth, so that you're allowing yourself, so that if you do screw up valuation or something like that, that you can still not lose money. And Warren Buffett's rule is shoot for a 20% safety margin. And he said the three most important words in investing are margin of safety. And then the third way to manage your risk is through hedging, which is really you're purchasing insurance so that if things hit the fan, you're getting out without losing everything. So this is, I hope that was very helpful for you for getting a really solid understanding of how to think about investments and how to make your own decisions. And I presented Ray Dalio's strategy. So, one, I always recommend reading the book itself so that you can get a deep understanding of something. I always preach, before you choose something, understand it. So always recommend reading the book and understanding it for yourself. But if not, at least do some research, do some additional research on your own for this. But I also do want to say that this is what I also put my money into. So that's just me being fully transparent in terms of my security bucket. All right. So cool. Fun. I love this. All right. So Waterfall financial management. How can you think about setting up your Waterfall financial management strategy step by step? So if you remember from part one, the overall philosophy behind it was you're going to be making X amount of money, and you want to have fixed percentages for what you're going to do with that money in a very specific priority. So the recommendation here information and guidance is, one, if you're going to set money aside for charitable contributions, do that at the top. And then you're going to have X percent to savings. And then the next level of the waterfall is X percent to high interest debt like credit cards. Then the next part of the waterfall is X percent set aside for investments. And that's for your security bucket, a growth bucket, and dream bucket. So you're investing before you're spending. And then the sixth level of the waterfall is allocating money to low interest debt. This could be student loans, car loans, a mortgage, etc. And you always want to make sure that you have enough money to pay your debts. You never want to miss a payment on your debt. It'll wreck your credit score. So payment history for credit scores is super, super important. And then the next level of the waterfall is allocating X percent to your cost of living. And then whatever's left over after all these different levels of the waterfall, that's what you want to have left over for personal spending. Most important part of this philosophy is invest before you spend. This is why most people are never wealthy. They spend before they invest. And you got to invest before you spend. All right, so you're going to have that money coming in, whether it's pre-tax or after-tax. The very first thing, and this slideshow, this specific slide is going to be showing you the cash flow. Like, what is your money doing, and what accounts do you want to be thinking about putting your money into, in what order? So you're going to have money coming in from wherever you're working. That's going to be your active income from the company or from the organization. Now, the first thing that you're going to need to do is tell that organization or your company how much money you want them to withhold for your retirement account, for your 401k, your 403b, or 457. So if you're making $100,000, well, you're going to need to tell them to take out for either pre-tax, if it's a traditional 401k, it's going to be pre-tax, or if it's a Roth 401k, it's going to be after-tax dollars, but you need to tell them how much to pull out. And that's going to go to your 401k account, your 403b account, or your 457 account. Then, after that money's taken out, the remainder of the money is going to be dumped into your checking account. Well, now that money's in your checking account, now you start to actually implement your waterfall. So immediately you're going to want X percent sent to your savings account. Maybe that's 3%, maybe it's 5%. You get to choose the percentage. So X percent's immediately sent to your savings account. Then you're going to want to have X percent sent to pay off your high interest APR debt. So if you have credit card debt, immediately after you put money into savings, you're going to want to take that money and then boom, pay off high interest APR as well. After that, you then want to go and send X percent to your investment and your health accounts. So this is going to be your 401k, your 403b, 457. So this first part here, this might be up to your employer match. So maybe this is 3,000, maybe this is 4,000, 5,000, 6,000, whatever. But like here, you definitely want to make sure you're taking advantage of your employer match. But let's say that you still have some money left over for investing. Well, now you want to send that money and max out your tax advantage accounts. And after you've taken advantage of your tax advantage accounts, then you want to, if you still have a certain percentage of money left over, well, then you still want to use that money for investments. So maybe this money is going into your retirement accounts, your IRA, a brokerage account, private investments, HSA or FSA, your 529 or your ESA, which are your education plans. And really these are your security growth and dream buckets for investments. So after you've set money aside for investing, then you're going to have number 6, which is your low interest APR debt. So that's going to be your mortgage or your car loan or your student loan. If you have a phone loan, like any type of low interest APR debt. But you always must make sure you have enough money to pay your debts, at least the minimum balance. You never want to miss a debt payment. That will wreck your credit score. So then number 7, after that is your cost of living. So this might be 40%, it might be 50%, it might be 60%. And then after you pay for your cost of living, whatever's left over is your personal expenditure for fund money. And really this money, the reason I have it in black is this money for your cost of living and your personal spending, that money is going to be in your checking account. So you always want to at least have 1 to 2 months worth of cash in your checking account. Now, if someone is, quote, living paycheck to paycheck, and I don't know your situation, maybe you are, maybe you're not, maybe you know someone who is, but paycheck to paycheck means that literally you're getting money from your work dumped into the checking account and you're immediately paying for cost of living and there's nothing left over. There's no money for savings, there's no money for investing, there's no money anything. So ideally what we want to do is keep at least 1 to 2 months of money for cost of living in your checking account, and then anything over and above that should be put into, you want to make sure that you're running your waterfall. So 1 is you're investing, taking advantage of the employer match, and then 2, it comes into your checking account, it goes into your savings account, X%, and then you pay off high interest APR debt, then you send money to your investment accounts, and then you pay off low interest APR debt, and then with the remaining money in your checking account, you're paying for your cost of living, and then anything after that is personal spending. This is this plan alone, fewer than 90% of people in America have a plan like this. And the reason I'm saying America is that's where I am. So very, very, very few people have an actual strategic plan for how to build wealth and manage their money both in the short term and in the long term. If you stick to something like this, this is, I believe, a great strategy for you. And maybe you implement this and then you decide that you want to change a couple things. Great. It's totally up to you. But having a plan that you stick to, it's a system. A system will build you wealth. And that is the goal. Have a system that you stick to consistently that will build money for you and earn a return over the long term, and you will become wealthy. So several kind of high level steps from 1, 2, 3, 4, 5. So 1, determine first where you're going to open and manage in each account. So you're going to need a checking account, a savings account, your own individual IRA, and maybe a brokerage account. Your 401k and your health accounts are going to be primarily set up through your employer. So the decisions you'll need to make are checking, savings, and your IRA/brokerage. So personally, and I'm in no way affiliated with them, at least as of now. Like as of this video, I'm not affiliated with any of these institutions. I personally use Charles Schwab for my checking account and for my IRA and brokerage. I just really enjoy them. Great technology. There's a portal where I can see all of my finances literally in one dashboard, including my credit cards, my debts, my investments, my cash in checking and savings. So it's great. And then in terms of savings accounts, I prefer Marcus by Goldman Sachs, Ally, and Capital One. I personally use Goldman Sachs. So again, I'm only including those for information. Now for 2, determine your allocation percentages for your waterfall. And that's you deciding X% for every single level of the waterfall. And I'll show you the spreadsheet shortly for doing that. And then 3 is you want to set a cost of living target and ceiling. And if you remember from part 1, we talked about as you make more and more money, a lot of people allow this lifestyle creep to eat their money. It turns into a monster. And because of that, that monster continuously eats the cash flow that they need for investing. And so if you don't limit yourself as you make more and more money, you're never going to get ahead. You're never going to accelerate the machine. So maybe a super great cost of living for you would be, that free and clear, I can spend 50 grand or 60 grand or 80 grand on my cost of living, and anything over and above that I'm taking home, I can invest that. Well, because you limit yourself, as you continue to make more and more money in the future, and if you're someone going through this program and you're doing this personal work, you're focusing on your personal development, you're maximizing your personal performance, you're negotiating for what you're truly worth, and you're managing yourself as a business, you are a service provider in the marketplace, you're going to make that money. But are you going to be the person who sets the cost of living ceiling and accelerates your investments and achieves financial independence and financial freedom fast? That's the goal. Man, that's cool if you can do that. So, and you can do that. And then number 4, begin allocating your money every month. So begin to implement the system. And then 5 is check your accounts and your finances every month. So you don't want to become the person that becomes obsessive and becomes crazy involved and like checks their stocks and, all that 1%. Oh my God, it went up 5% today. Oh, it's down 3%. Oh, I hate myself. And like, people just freak out about their finances. You want to have a healthy gauge of your finances. If you check it once a month, you will, as long as you've set up a good system and the timing too. Oh, I want to talk about timing. If you do set up auto deposits, auto pays, auto invest, make sure that the timing is set up properly. So if you know that your paycheck is going to hit on the 1st and the 15th of every month, well, you want to make sure that your payments are after the 1st and the 15th. Otherwise, if those payments hit and you're withdrawing on a day when your check hasn't hit, well, that's a problem. You might have an overdraft. So always make sure the timing is aligning for your automatic payments and your automatic deposits, auto invests, everything auto. All right, so I do recommend auto deposits, auto pays, auto invest, auto reinvest. As much as you can, make everything automatic because it will make your life super easy and automatic. I literally only check my finances once a month because I know my system, I trust my system, I built my system, and I know it works. So I check it once a month, and then I rebalance my investments once a year, which we'll talk about in a second. 6, you will need to rebalance your investment portfolio annually because of what's called portfolio drift or allocation drift. Now, if you're only in one asset class, are you going to need to do this? No, because you're only in one asset class. It also means that you're exposing yourself to all the risk of one asset class. So if you have an asset allocation and you're diversified across asset classes, over time, the percentages allocated to those asset classes will drift. Because if you remember that crazy checkerboard, some asset classes will do really well in 1 year. Other asset classes will do poorly. Well, the ones that do really well are going to become a greater percentage of your portfolio. The ones that do poorly are going to become a smaller percentage of your portfolio. So the percentages in your portfolio have, quote, drifted. So the benefit of doing a consistent rebalance is it forces you to sell a high-performing asset class and buy an underperforming asset class. Now, what I mean by this is think of this when stocks are doing really well. So one asset class, equities, when U.S. equities or U.S. stocks are doing well, that's one asset class. When those are doing really well, a lot of people don't want to sell. They're like, oh, no, it's going to keep going up. It's going to keep going up. But they don't know if it's going to keep going up. They're hoping it's going to keep going up. Well, the best time to sell is when they've gone up. But what a lot of people do is because they don't have a system for when they need to reallocate or when they need to rebalance, they keep riding and riding and riding, and then eventually it falls, and then that's when they start selling because they realize, oh, now it's over. It's no longer high. It's now on the decline. I'm going to sell. Well, they're allowing their emotions to dictate when to rebalance. The best time to sell would have been when it's high, and really what you want to do is capture the gains when it's high, take those gains, and then buy underperforming asset classes because you want to buy low, sell high. And that's like the ridiculous advice that people have heard over and over, buy low, sell high, buy low, sell high. But like people don't do it because they're trying to time the market. The thing is we naturally, unless you're an extremely skilled investor like Warren Buffett or Ray Dalio or whatever, it's extremely difficult to time the market. So what we want to do is completely remove our judgment and our emotion from when to buy and sell. And the way that we can do that is set a time every 13 months. I'm going to rebalance my investments. And it's diversified. So I'll move money from this asset class into this asset class based on what did well this year and what did not do well this year. And if you're consistently doing that, by nature, you're going to force yourself to consistently buy low, buy things when they're low, and sell things when they're high every year. Now, let's say that stock market, let's say that one asset class goes up, let's say 15% in a year. Well, if you're doing this, are you maybe going to juice out every last percentage of that run? No. Maybe when you rebalance, maybe you only got, 10 or 11%. Well, that's still great. And you locked in your gains at 10 and 11%. And then you took those gains and then bought something at a low price. And then perhaps over the next 13 months, that thing that you bought at a low price, that asset class is going to do well next year. And that's the basis of the checkerboard. It's like we don't know what asset class is going to do well in what year. So I know what did well this year, and I'm going to lock in my money. I'm going to sell it high, take that money and buy something low because odds are, I don't know what's going to do well next year, but I know that this did well and that did poorly. So I'm going to lock in those gains and then reinvest in something lower. That's the idea behind rebalancing and reallocation across asset classes. So now the reason 13 months, I'm sure you've been wondering, why 13 months? Why not 12 months? The reason for that is if you have an investment and you sell the investment within a year, within 12 months, what's going to happen are those earnings, those investment earnings are going to be taxed as normal income. So think of your normal income. Maybe you're making, just to make numbers easy again, let's say you're making $100,000 a year. Well, let's say you're paying 30% in taxes, or actually let's say like 25% in taxes. So you're actually taking home $75,000. Well, if you're paying 25% in taxes, but you have investment income that you sold and you get short-term ordinary income taxes on your investments because you sold within 12 months, well, you're going to be paying your marginal tax rate on that. So you're going to be paying 25% on your taxes. So, because it's kind of like what they do is they pretty much take that income and stick it on top of your normal income, and they're going to tax you at whatever that marginal tax rate is on top of that. So you don't want to be paying I ordinary income taxes on that money. You don't want to do that because it's, again, reduce the amount of taxes you're paying. That was Jack Bogle earlier where he talked about maximize your tax efficiencies. So if you sell or rebalance after 13 months, anything that you sell, you're only going to be paying long-term capital gains taxes on it, which is 15% for most people. And if you're making a really large amount of money and you're very, very wealthy, then you'll pay 20%. But that's paying 15 or 20% for your long-term capital gains investment income is great. That's much better than paying higher tax rates. All right, so I want to show you an example of what does portfolio or allocation drift look like. So let's just use Ray Dalio's portfolio as an example. So if we have 40% in long-term U.S. Treasuries, and then 50% in intermediate U.S. Treasuries, 30% in U.S. equities, 7.5% in gold, and then 7.5% in a diversified commodities basket. All right, well, let's say that after 1 year, equities did really, really well. Well, that's going to take up, because that amount of money grew, the value of that grew, it's drifting from 30% to 42% of the portfolio. Well, now the other allocations are going to have their own performance. So maybe the long-term U.S. Treasuries underperformed a little bit that year, and maybe these underperformed a little bit that year. So this increased, these decreased slightly. And then based on how gold and your commodities basket perform, maybe those drift a little bit. So this goes down to 7%, and then maybe gold goes down to 6%. So these allocations have drifted. At the end of 1 year, by rebalancing, by bringing these numbers back to what they should be, what you're forcing yourself to do is sell a little bit of your equity allocation, your U.S. stock market, or if you choose to do a slice of international equities. But what you're doing is you're selling a little bit of this asset class, you're locking in those gains, you're taking those earnings, and then reinvesting those earnings back into the other asset classes that slightly underperformed that year. Because perhaps next year, these asset classes are going to outperform and equities underperform. So you're forcing yourself to rebalance. You're forcing yourself to sell high and buy low consistently with no emotion whatsoever. Now, an example of where this is extremely powerful. In 2008, when the market crashed, because people did not have a system, because they were making emotional decisions, they sold when they freaked out. So markets tanked, everybody freaked out, and the worst thing that you could have done is when the market tanks 30%, they all of a sudden start selling their equities. Because as we talked about in part 1, Warren Buffett, if you remember the slide I'm thinking of right now, if you lose 50%, you have to make 100% back to get that. And rule number 1 is don't lose money. Rule number 2 is see rule number 1. Well, same thing happened in coronavirus. The markets plummeted, everybody freaked out, and they literally started selling money that they wouldn't even be touching anyways for 3 years, 5 years, 10 years. Well, that's craziness because they're making an emotional decision and they're locking in their losses. Really, the best thing to do would have been to buy equities. But at that time, emotions were not telling people that. Emotions were saying, it's going to fall further. It's going to fall further. It's not done yet. This thing's going to keep plummeting. But if you had a system where it says, all right, every 13 months, I'm not even going to look at what the craziness in the markets are doing because the money invested in here is for the next 20 years, 30 years. I don't care what's happening in the next 12 months because it's not going to affect me. The only thing that matters is what's going to happen over 20 or 30 years. Was coronavirus going to cripple the entire world and literally blow up the global financial markets for 30 years? No. So when people started selling money that they were investing for 30 years over something that was short term, it's kind of crazy. But they made that decision because it was emotional. So by having a system and following a rebalancing every 13 months and knowing that it is a system, you're taking the emotion out of it. It is extremely powerful. And you will be able to make better decisions naturally, automatically, and systematically than the vast majority of investors, even professional institutional investors. A lot of people view institutional investors as these people who are extremely skilled and they're just the best in the world at what they do. Some of them are. Like Ray Dalio said, some of the gold medalists absolutely are just genius. But the majority aren't. The majority are just as emotional as the average retail investor. But what's scary is they're managing a massive amount of money. Hundreds of millions of dollars, billions of dollars. So you often can outperform many of the best in the world just by implementing a long-term systematic approach where you're stripping out the emotion and you know that this money is invested for 15, 20, 30 years and you just follow a simple system that you stick to. Okay, so again, I'm a coach. I'm providing you with information. I'm providing you with ideas for you to explore and for you to understand to make a decision on what do you believe is best for you. I don't know. You might be in your 20s or 30s. You might be in your 50s and 60s. So recommended further reading. Some of the books that I think carry phenomenal concepts and really further break down a lot of this core understanding. So one, Money Master the Game by Tony Robbins. Amazing book. Absolutely highly recommend. I Will Teach You to Be Rich by Ramit Sethi. This is a great book as well. The Richest Man in Babylon is a very short book, but it's worthwhile by George Clason. The Autobiography of Benjamin Franklin. Now, the reason I included in this is there is a lot of core philosophy that a lot of people miss when they read this autobiography, but he includes a lot of deep core philosophies for money management, for wealth management, for personal development, for investing in yourself, for creating ideas. I love that book, and I highly recommend it to everybody. If you haven't read, and it's so crazy because it's like, here's one of the most successful entrepreneurs and also politically involved people in the U.S. economy. He was there for the Constitution. Like, he was an advisor and a part of that group of the founding fathers. So not only was he very financially and economically successful, but in terms of diplomacy and politics, I mean, his ideas are fantastic. So the autobiography is him sitting down and saying, how did I become so successful? what did I do? But even more importantly, it has his thoughts and philosophy. It has his reasonings within it. All right, and then the next book is The Intelligent Investor by Benjamin Graham. This is a book where I highly recommend it for if you're going to be choosing individual investments, whether they're specific individual private investments or specific individual companies or public investments. That's a book that is great for growth investing and taking slightly higher risk and making decisions on individual investments. And then Warren Buffett's annual letters to shareholders. I love these because similar to why I just said the autobiography of Benjamin Franklin is great, it's Warren Buffett's thoughts in a letter. And you get to, it's kind of like getting access to the inside of his mind. Why does he think the way that he thinks? Why did he make these decisions? It's the reasoning behind them and the beliefs, the principles behind his thinking. So, and then a YouTube video, understanding the world and how the economy works. How does debt work? How does Fed policy work? And how does that influence all of us, the individual economy, the companies, individual consumers, the globe, literally global financial markets. So excellent video. It's only 30 minutes. And in those 30 minutes, you're going to learn more about economic policy, how the economy works, and how the financial markets work in 30 minutes than you probably have all through your both graduate or undergraduate education, but as well as your K through 12. So super powerful video. All right, so now the last part is I want to go through the individual spreadsheet that you're going to have access to for building out your Waterfall financial management system. So the allocation percentages. All right, so let's pull this up. So you're going to have access. The first kind of slide here is just my copywriting. All right, so now you have the first slide or this first tab. So one, calculate your cost of living. So the very first thing you want to do is go through your finances over the last month or 2 months or 3 months and figure out how much am I paying just to live, to literally to live. So you're going to have your rent or mortgage. You're going to want to come up with what that is. Your utilities, so food, water, garbage, / waste, electricity, whatever. And then, or I'm sorry, not food. Food's down here. So then you have food. How much are you spending on food per month? How much are you spending on transportation? And transportation is, think of that as like a car bill or gas, anything like that. And then out-of-pocket medical expenses. And then you're going to have personal care / toiletries, so haircuts, toothpaste, deodorant, toilet paper, whatever. And then your phone and internet, rent and home insurance, health insurance, life insurance, auto insurance, any other type of insurance. We have a lot of different types of insurance available. If you have children or other dependents, so childcare and other types of needs similar to that, pet and other needs, and then any other type of continuous living expenses that you have, you can kind of bucket this into the final bucket here. Now, so these blue inputs, these blue boxes will affect all the months of the year. So you can see here, I entered in terms of color coding, and this is just for good principles for anytime you're doing a financial model. Anytime something is not a formula and you're manually typing in a number, you want to make that font color blue. Because if you are looking at this model later on, or if you're sending this to somebody, or if anyone else is going to go into your Excel, if everything is black, if all the fonts and numbers are black, they don't know what's a formula and what you manually typed in. So anything manually typed in you want is blue. So you can see I manually typed in, like, let's say 1100 is rent. Well, this blue is going to affect the formulas for all these separate months. So because I typed in 1100 here, January, February, March, all these months, the rent is going to be 1100. But now let's say that you're in the apartment here or house, and let's say that you move somewhere in June and your rent is no longer 1100 in June or for the remainder of the year. Instead, it's going to be, let's say, 1500. So you can see here what says manual input. So all of these different inputs here for cost of living, you can choose either a yearly input or a manual input. So for the manual input, let's say from June on, let's type in 1500. So now you can see that this manual input changed June to 1500. Well, all of these are still pulling from the annual. Well, we need to change these to monthly, or manual inputs. So 1500, 1500, 1500, 1500, 1500, 1500. Okay, sweet. Well, now we can see that this annual is going to be adding up all of the money paid January through December. So you can see that annually you're spending for rent and mortgage $16,000, which is 50% or 56% of your total, which is pulling from down here, your total annual cost of living. So the exact same things for utilities. Let's say 100, 100, 100, and then you move in June, and maybe it's now 150. So you can change this to 150. Well, that's too much. 150, 150, 150, 150. Okay, cool. So now we can see that. So I hope you're seeing how easily you can manipulate and input data in order to calculate your cost of living, one, annually. So maybe you're maybe you're going through this in January. Well, you can literally model out and financially lay out what are my finances going to look like for the entire year. You can choose what these are going to be per month or annually, and then you can look at what are my totals going to be per month. So this is, 2,140 for January. This is my total cost of living. And then for February, it's going to be the same. And then January, but then you said we moved in June and we started changing. So we changed rent to 1,500. We changed utilities to 150. Well, now you can see that the monthly cost of living for June is higher. And then all the remaining months going forward are higher. And then this final summary total cost of living is summing all of the annuals. So, and you can see it's calculating here the annuals. It's whether or not you sum these or if you summed all these along the bottom, it would equal the same. So for example, if I highlight these, you can see here the sum right here says 28,830. Well, that's the same as this, which is summing up the side. So this is how you can calculate your total cost of living. Now, let's go to the second tab, which is your waterfall cash flows. This is where you're going to choose the percentages that you want to allocate to the different levels of your waterfall. And also, I know that this spreadsheet might look overwhelming. If you're not very comfortable using Excel, you may be looking at this and going, oh my God, there's so many numbers. That's okay. I promise it's once you start using this for yourself and you play around with it a little bit, you start popping in numbers, you'll immediately see how easy this is to use. So walking through how you're going to input information into the second sheet is, again, you're going to have months. So you're going to have January, you're going to have February, you're going to have March, April, May, June, July, etc. So the very first thing you want to think about is, all right, after-tax income. How much money am I going to be making after tax? So of this $5,000, my level one is how much money do I want to set aside for charitable contributions? Well, maybe right now you believe, okay, right now I'm not in the position, maybe 0% or 1%. All right, so, for this example, I'm just putting aside 2%. Now, also, I love bringing this up because the fact that, so 2% on $5,000 a month is $100. A lot of people will literally spend $100 going out for, drinks or a dinner. If you were to take even just one night of drinking off or one restaurant visit out, I mean, it's pretty cool what you can do with, at the end of the year, $1,200. It's really cool what you can do with that. And imagine as these numbers get bigger and bigger and bigger, how much you can give back. It's awesome. All right. So anyways, so you determine whether it's 0%, 1%, 2%, whatever. All right. So if this is 0% or 2%, we're going to go 2% for this example. The next level of your waterfall is savings. So how much are you going to set aside for savings? Well, 5% of $5,000 is going to be $250. So this is the amount in January that you're going to send to your savings account. And then let's say for debt repayment, if you have credit card payments or credit card debt or anything like that, well, you don't want to just pay the minimums. You want to be allocating a fixed percentage that you can afford to send to that debt payment because you want to pay that down. Now, in this example, let's assume that you don't have any credit card debt. So let's go 0%, 0%, 0%, 0%, because all these months you don't currently and you don't plan on carrying any credit card debt. So we're making that 0%. You're not allocating any money there, which means you're going to have more money for your investments. So Now, going down, so you can see at the waterfall, you've already allocated $250 and $100, which means that if we were to do, 5,000 minus your 100 here, minus the 250 here, well, going into your investment part of the waterfall, you still have $4,650 to allocate. So, next level you're going to need to do is decide, where am I allocating this money in terms of my investments? So, this decision for the 401k, like the employer-sponsored investment accounts, so the 401k, the 403b, the 457, even though it's down here on level 4 of the waterfall, realistically, you are going to have to make that decision before that money hits your checking account. Because again, the employer, your employer is going to withhold that money before they send it to you. So, but in this spreadsheet, you're still going to want to decide, how much do I want to tell them to withhold? So maybe so in this example, 10% of 5,000 is going to be 500. And then for your Roth IRA, how much do you want to be contributing to your Roth IRA? Well, then let's say 5%. So that's going to be $250 a month. And then if you have a brokerage account and you want to be funding that, maybe you're doing some type of, I don't know. I mean, if you want to put money, but again, this is security bucket. Security bucket is different from your growth investments. This is long-term. Whenever you think security bucket, think like 20 to 30 years. This money will be invested long term. Now, growth bucket is higher risk. So security bucket is long-term, lower risk. Growth bucket could be short or long-term, but the idea behind the growth bucket is you're taking higher risk. So these could be individual investments. This could be an individual property investment. This could be choosing one specific type of stock, like investing in Nike or Coca-Cola. Could be one specific type of bond, etc. So how much money are you investing into your security bucket for these different investment accounts? And then how much money are you putting into your growth bucket? And in this case, let's assume that you're going to start putting aside. So if these are, primarily retirement focused, well, maybe you want to start saving money on the side that you can use to buy a real estate property in the next 5 years or 10 years. So let's say that if you don't want to put it into a retirement account, if you're trying to use it in the next 5 or 10 years, because you won't be able to access that money earlier in your life than 59 and a half. At least as of now, that's the rules. Because if it's a tax-advantaged government account or tax-advantaged account, if it's an IRA, if it's a retirement account, you're not able to touch that money, or at least you're not able to spend and use that money until 59 and a half. So if you want to be able to spend and use that money before you're 59 and a half, so as an example, I know that I want to be able to save up money and then invest in a property, and then as I make money from that property, I want to be able to use that money for, buying things and continuing to reinvest and grow, etc. Well, I need access to that money. So maybe I put aside 5% for, growing a down payment for that. So even though I put brokerage here, maybe you're putting this money into a savings account. Maybe you're putting it into a brokerage account. The whole idea is you're not locking up this money for your growth bucket here. You're not locking it up into a long-term retirement account. So maybe you're putting money aside there. And then for a dream bucket, whether you're putting money into a brokerage and investing through a brokerage account, or if you're just putting it aside in a savings account. So as an example, maybe you're putting 8% aside because you plan on buying your dream house, let's call it 15 years from now. So you're not 59 and a half yet. And again, this is an assumption. But let's assume that 15 years from now, you're not going to be able to access your retirement money. And so you want to start investing for 15 years from now, but you still want to be able to access that money 15 years from now. So you're putting down 8% for that dream, or maybe you're going to have a wedding in the next, call it, 2 years or 3 years, and you don't want to risk it in the markets. You don't want to risk it in any investment. You just want to keep building this on the side. Well, a savings account is perfect for that. So let's say that you start putting aside 2% for a wedding in 2 to 3 years, or maybe a honeymoon, or an awesome vacation with your family and friends, whatever. So you're putting money aside there. And notice that you're going to need to update every month that you're allocating X% to that. Cool. So, and then also I said we're setting aside 5% here as an example for that real estate down payment or that real estate investment. Okay, well, we need to do that monthly and put in every month that we're allocating 5%. Awesome. So at the end of a year, that's $3,000. Cool. So now if we do debt repayment, so maybe this is student loans, maybe this is a car loan, and not all loans you can pay above your monthly payment. So for example, your car loan, it may be a 5-year loan. Well, sometimes you can't accelerate the payments. They literally say you cannot overpay. But I know for student loans, many different types of student loans, especially if it's a federal loan, your minimum payment may be, let's call it $200. Your minimum payment may be $200, but you are the one choosing how much you want to pay off. And so if you're setting aside 7%, well, obviously 350 is above 200. Well, that's great. You're going to be setting that aside and paying off that debt faster. Great. So let's say that you're setting aside 7% every month for debt repayment. Well, at the end of the year, that's $4,200. And then your cost of living. So see here that this is green. So we talked about how blue, anything that's blue text is a manually input number. Anything that's black is a formula. So these are all formulas. Well, anything that's green means that it's linking to another tab. So you can see here where it says calculate cost of living. Well, calculate cost of living is this tab. So this number, 2,140, is pulling from cell E36 on the calculate cost of living tab. So E36. So if we go to column E, and we know that this is column E and column E and row 36, which is total cost of living. Well, E36 is 2,140. So if we go back to this tab, we know that this January total cost of living, 2,140, is pulling from here. So that's why it's green. And you can see that's pulling for every month. So if this is pulling correctly, we should know that June, we said that June we're moving apartments, or we're making a change and we're going to be paying more in rent and utilities. Well, that was 2,590 in June. So you can see here in June, the total cost of living is linked and increases to 2,590. So this is where this number is coming from. And what's cool is you can see that your total cost of living it's calculating as 43%. Well, what this is saying is 2,140 is 43% of 5,000, which is your after-tax income for January. So if you know that based on, and I'm going to go back to this this really quickly. So if we know that you've only allocated, so here for your cost of living, if you told yourself, well, I'm only gonna spend 40% of my income on my cost of living. Well, if you said only 40%, you would be able to look at this and go, I know I'm over by 3%. Okay, well, what are you going to change in here to get to 40%? Or maybe you said, well, I'm going to choose 50% for my cost of living. Well, sweet. Now you look at that and you're like, wow, I'm beating that by 7%. Awesome. What do I want to do with my other 7%? Well, maybe you decide that, all right, well, I want to put that other 7% and accelerate my, let's say long-term. So your Roth IRA, instead of 250, let's say you do, boom, 12%, and you put the 7% there. Well, now all right, you actually can't, because I know that 7,000, there's max contribution limits. This is actually, I think, high for individuals. So let's just say that we do 10%. Cool, 6,000. And I believe that's right where so as an example of how you can look up contribution limits. So if we do IRA 2021 contribution limits. All right, so the annual contribution for 2019, 2020, 2021 is 6,000 for most people, or 7,000 if you're age 50 or older. All right, so sweet. We know 6,000 is the limit. Well, great. You just crushed that. We know we hit the limit. Awesome. And you're still at 43% here. We allocated, we said 7% would have brought us to, well, you allocated part of that 7% to here. Awesome. All right, well, that still leaves us with 8% left over for personal spending. And the way that this 8% left over for personal spending is being calculated is it's taking, you can see here that if we go into the formula for 410, well, we know that it's taking 5,000, so E6 here in the formula, E6, which is 5,000, minus the sum of all of these other parts of your waterfall added together. So that's 5,000 minus, and the way that we could even do this is literally do 5,000 and check it with 410. So this 410 is being calculated by taking 5,000 of your total income minus the sum of all of your other allocated investment or other allocated percentages, which is 4,590, and that's giving you 410. So that's money left over after all the other pieces of your waterfall that you can decide, all right, I want to go out with friends. I want to go to a restaurant. I want to buy something nice. I want to, that's money left over just for pure personal spending. And then you'll never feel guilty spending this money because you know you've done everything else you need to do. You've invested. You've set money aside for savings. So like a lot of people feel guilty like, oh, I shouldn't buy this because I know that I should be investing. I should be doing it. You will never have that feeling because you know that you are on top of your stuff. You're killing it. You have a machine. You have a money machine. You're growing it. You'll never feel guilty. All right. So now this bottom part of and also, as long as you, I'm sure you've already seen this, but you can individually change your percentages for every month. And this is adding up for annual, and it's also adding up here at the bottom as well. So this 5,000 it should and will equal your monthly total of income because your personal spending is calculating the difference. Now, what if you accidentally over allocate percentages? What if you put in more than 100%? Well, you can see here, it started getting red. Minus 1%, minus 1%, minus 1%, $40. Well, if you're still spending and this is negative, it means that you're technically, if you were to continue spending, you would be going into debt because you don't have enough income. Now, the reason that this turned negative right here, negative 40, is because look at the cost of living. Your cost of living jumped in June from 2,140, which is 43% of your income, to 52% of your income, 2,590. Well, that's not good. So maybe, you shouldn't have taken that apartment, or maybe you should have looked at something that would have been more in line with 50% goal. Now, maybe you do want to do 50% and you're okay with going a little over. Okay, well, that means you need to take away money from something else. You need to under allocate to something else. So maybe that means the money you're setting aside for, let's say, this would have been this contribution, this dream bucket contribution. I think the example I gave was future home. So maybe you need to reduce this to 6% in June. And now you can see that now you're in the clear again with your money. Okay. So I hope you're seeing how easy this is to manipulate and change and to easily reflect and plan your personal finances for all the different levels of your waterfall. Now, this bottom part here, this is if you're going to be using a pre-tax tax advantaged account. So for example, your pre-tax income wherever you work is obviously going to be higher than your after-tax income. So if you're earning $6,000 in pre-tax income, well, after taxes, you're probably going to walk away with something like $5,000. So you're going to need to update what is your pre-tax income wherever you work. And then you also need to update what is going to be your after-tax income. Now, the reason this bottom section here is because you'll want to decide, am I allocating money to a pre-tax advantaged tax advantaged account? So this could be your traditional 401k if you have one. It could be a traditional IRA if you have one. Or it could be your HSA healthcare plan or your HSA savings account or your FSA account. And also in terms of HSA 2021 contribution limits. All right, well now we know that for The annual limit on HSA contributions for 2021 will be $3,600 for self only and $7,200 for families. Great. So now we know that $3,600 is the limit. So if you were contributing money to your pre-tax income, you'd want to choose, all right, how much I'm putting in for my HSA. Maybe you do, 4% of your pre-tax income. So that's going to be 240, 240, 240. Cool. So now we know that's 2,880. Well, if you're going to do this, if you're putting money into this account, well, this most likely, if you're putting money into this, that's going to affect your after-tax income. So always make sure if you are putting money into your pre-tax accounts, you're going to need to know, okay, if I'm putting this money in, how is that affecting my after-tax income? And you may need to update these numbers. So again, if you're contributing to any of these pre-tax tax-advantaged accounts, figure out these numbers first, and then that will affect your after-tax income, and then put in your after-tax income up here, and then decide your waterfall with those after-tax income numbers. So I hope you see, again, how easy this spreadsheet is to plan all of your finances. And after you've mapped this out, then this third tab it's just an overview. It's a snapshot of all of your finances for the year. So you can see, all right, for charitable contributions, I'm going to have $1,200 at the end of the year to, contribute to whoever I want, to invest in any, nonprofit or whatever I personally care about. Or, maybe this is money that you're setting aside for a family member or for a sibling or for a specific friend, something. But then, all right, so how much money have I saved this year? Well, you can see that in January, February, so this I will change. This is it is not January every month. That would not be good. We need better weather than that. I would never wish January every month on anybody. All right, so now you can see you have all the months, and then in terms of the snapshot, so you can see how much have I put aside all the months of the year for all these different waterfall levels, and your total summaries for the year. So $12,000, you've invested at the end of the year $12,000 in your security bucket. You've invested $3,000 into your growth bucket, and you've put $5,300 into your dream bucket, and then you've put $4,200 towards your debt repayment for low interest, and you've set aside, or you've spent $28,830 for your cost of living, and then personally you've spent $2,470. And in total you earned, so your total income at the bottom here is the same as how much after tax you earned for the year. So this is it for how to use and set up your waterfall financial management spreadsheet. This is your system for you. And again, in terms of the investment sides, like, okay, well, what should I be putting my money into for these investment buckets? I've presented kind of the Ray Dalio strategy, and there's also, I've recommended further reading in order to further educate yourself on those choices. So this is it for the end of module 12 and the end of our time together in terms of the content training. And so with that, I wish you all the best. Get excited about the financial freedom. Be excited about what you can achieve with your finances. You absolutely can get to where you want to be in the future. It's just you got to have a strategy and you need to implement it consistently. So thank you so much for listening to this. I'm excited for you, and I hope that you're excited to start tackling your finances. Talk to you soon.